really is money. So this is from Bank of America. Their research shows you that the probability of you having a negative return on your equity investment over a 10-year period is 6%, meaning that if you put your money in today, in 10 years' time, the likelihood that you've lost money is really low. So again, this is why shouldn't time the market and should be looking to have as much equities as possible in your portfolio. So again, this chart is just again to show you that what if the company that you found is not just growing in line with inflation, but can grow better than inflation. This is again the rule number 1 and rule number 2, right? Finding good companies with good secular business models. So again, this chart that you see here is that dark blue line is the earnings, so the profits of your tech companies, including media, telecoms, Facebook, Google, your Amazons. And you can see since the last financial crisis, their earnings have grown, more than doubled. But for the other companies around the world, their profits have just recovered to where it was in the sort of great financial crisis kind of thing. So again, this is why you need to have a strategy or invest in someone with a strategy to make sure that the profits of the companies that you're invested in are growing faster than sort of your general inflation. So this is basically strategy number 2, which is, you have to think about what is my investment strategy, or look for a manager with an investment strategy. Okay, so I'll recap the 2 strategies later on. I'll just go into strategy number 3 first, which is, okay, diversified asset allocation and having a plan on how you allocate your different asset classes over your own life kind of thing. So this is what I mean. So earlier I showed you that chart from Vanguard. On the right-hand side was where the equity-only portfolio sits. So, it's 100% equity, 0% bonds, and that's why you had that sort of 10% return per annum. Now, on the left-hand side, this is what you get if you invested in only bonds. But the real benefit is being somewhere in the middle, where you have a mix of bonds and equities. So what you can see here, a portfolio which invested 60% into stocks and 40% into bonds over the last 100 years gave you a return of 8.7%. So if you think about it, this is about 15% lower than your pure equity book. But if you look at the drawdown, it's 38% lower, meaning that for each return, for each unit of risk that you take, your returns are optimized when you mix the 2 asset classes together. And the reason why this is important is, again, so obviously investing in equities is great, right? Because you get very good returns. But as we talked about, you have these periods of boom and bust. So what if you were planning on retiring in February of 2020, like a month before COVID hit and the stock market went down 40% within the space of, 3-4 weeks. So it wouldn't have been great if all your money was in equities, right? So in this case, you have to risk adjust it. So part of managing investments is managing risk. So in this case, what you can do is, based on your age, have a different set of allocation to equities and bonds. So the rule of 100, which is a conventional way of thinking about it. So, let's say if I'm 35, I should have 65% of my investment portfolio in equities and 35% of my investment portfolio in bonds. So this way, as I get older, I will start shifting more and more into bonds in such a way that, by the time I retire, call it 60, I would have actually more bonds than equities. And as I grow even older, then you'll even have more bonds, which is obviously safer than these sort of, more risky equities, but also the rate of return, goes down over time. But again, this is fine because it's based on the risk that you're able to take. The only thing I'll just quickly touch on is on the right-hand side, you have the sort of newer age models where you're using 120 minus your age instead of 100. So maybe I didn't mention that. But on the left-hand side, the conventional model, the way it works is that you take 100 minus your age to determine what percentage should be in equities. Or the new age model, because we're living longer, you take 120 minus your age, and that gives you the percentage that you have to put into equities. So hopefully with that, you can manage the risk that comes with investing in the equity markets. So I'll just show you this as well, which is this is a bit more of the advanced class, if you like. Obviously, you can have a plan on how to allocate between bonds and stocks over the next 30 years. But sometimes within the next 3 to 6 months, it could also pay to have a slightly different asset allocation. So let's say if you think that the markets are due for a correction, not like a full-blown recession, but let's say it could dip by 10-15%. And in that time, it could be it could be good if you can shift some of the allocation away from equities into bonds or into money markets, depending on the sort of narrative at the time. And that way, you can sort of also manage the risk on a short-term basis, as well as have a plan for the sort of the longer term. So the short-term one is obviously a bit more difficult because either you have you can find a manager to do this for you, or you have to sort of study the market on your own and kind of determine how do you sort of play the sort of allocation on a more short-term basis between the sort of risky and less risky assets. So this is in a nutshell strategy number 3, which is you need to have the asset allocation. That does matter, and make sure that you're you think about, okay, how am I going to do this over the next 30 years rather than over the next 3 or 6 months or so. So I'm just going to recap the 3 strategies that I sort of talked about. So the first one is got to have the diversification on a global basis and on a sector basis. Secondly, you need to have or invest in an investment strategy, a philosophy, a way of investing that you can understand and kind of see the benefits and the merits of. So sometimes, I guess investor number 1 who DIYs, it's very easy for him to sort of think about this. But for investor number 2 who invest in different funds, again, try and understand, what fund are you buying? What is the fund manager thinking? What is the strategy before you sort of put it into your portfolio kind of thing. So the third one here is, having the sort of risk-adjusted asset allocation, or in itself being diversified. So not having just equities or just bonds or just fixed deposits. You've got to have really a good mix of bonds and equities. And there are places for FD in your own portfolio, and that's usually for emergency cash and that kind of use case. But for whatever you do, just think about duration. Meaning, how long am I investing this for? If your investment horizon is really long, then equities is always the best answer because that's the best hedge for inflation. The weakness of bonds is usually inflation. So again, that kind of tells you why bonds doesn't have that long of duration compared to equities. Okay, so then for the next 10 minutes, I'm just going to try and talk about the Nomura Strategic Growth Fund, sort of shorten it to SGF, where this was created in June of last year. And the way that we sort of arrived to this is, so I've been back here about 4 years or so, and working with the team at Nomura, and so speaking to as many people as we could, we tried to find, there's already thousands of funds out there, right? So what fund can we create that could help the investors to sort of achieve their long-term objectives? So what we did was we took the 3 strategies that I talked about, and we put it into this fund. And so I'll show you how it works. So SGF is a global multi-asset strategy fund, meaning that it doesn't just invest in stocks, it invests in stocks, in bonds, and we manage the FX risk because obviously we're Malaysian investors, we earn and invest ringgit, but because this is a global fund, the investments in the different currencies, we manage that FX risk for you as well on a dynamic basis. And the other way how it works is that it's not a sort of set allocation, meaning that you put, 60% equities, 40% bonds, and then it's just sort of left like that. What happens is that on a 2-weekly basis, we actually, with our team in Tokyo, kind of work out, okay, based on what we see happening right now in the markets, should we push equity down? Should we push equity up? So the allocation is very dynamic and it changes, it could be as short as every 2 weeks. But the whole idea here is that, we're managing your money for you. So think of us it's like a personal fund manager kind of thing. So it may not necessarily replace what investor 1 or investor 2 does. But for these investors, you could consider perhaps allocating a small portion of your portfolio to something like this, which gives you a very good base. And with it, you get the sort of global diversification because there's 70 names, 70 stocks being invested across all the major regions and across all the different sectors. And I'll kind of touch a little bit about, sorry, this is just the image on how in Clearate works. We sort of look at the different asset classes, and then we have the sort of tactical asset allocation, which is more that short-term kind of like investment decision, how much we put into different asset classes, as I mentioned before. But I wanted to talk about this. So when we invest in stocks in that 70 names, the way we do it, and this is strategy number 2, basically, you got to have that investment strategy, right? So what we have is we created what is called the secular growth framework. And through it, we identify the sort of future investment themes. So here, there's 5, internet, new consumer, hardware tech, software, and healthcare. So the idea here is that we want to look for companies within these 5 future investment themes that fit in that sort of structural business model. So you remember in my strategy 2, I had the sort of 3 rules. So in this case, we look for companies that can grow faster than GDP. And even if GDP is very weak, there's reasons why from a structural basis, they can still grow ahead and benefit from the sort of structural changes. And over time, it feels like these companies are like your future winners of tomorrow kind of thing. So within internet, you obviously got your Facebook, your Googles, and even if you think about stuff which like in new consumer, you've got this sort of athleisure trend, right? So your Nike, your Adidas, and stuff like that, whereby I'm going to work now, but I'm not wearing my black shoes anymore. I'm wearing my sort of Adidas sneakers, and this is again one of those trends of like wearing, wearing sports apparel, but not necessarily for sports. Like whether it's like yoga pants for comfort, or whether it's sort of sneakers for commute. This is how the world is changing. So again, even though we're sort of sitting here in Malaysia, why not invest in these kind of companies that are shaping our lives anyway? I mean, if you think about your time of day and how much time you sort of put into all these the names that I have mentioned, again, it makes good logic, I think, to be invested in these companies. The same thing with hardware tech, companies like Nvidia and companies who are sort of leading the sort of 5G transition, cloud computing, or within software, your Microsofts, your Adobes, all these companies are the kind of companies that you want to have in your portfolio, because you can invest in this for the next, call it 10 to 30 years. If you want to have a bit more color in terms of what I just talked about, you can go to our Facebook page. We've created some infographics that gives you some idea about what are these sort of future investment themes. But hopefully, it's something that can add to your knowledge. So the other thing I'll mention about the SGF portfolio is that, again, so strategy number 1, which is on getting that diversification. If you look at this chart on the left, again, this is how the portfolio is split. It's of the 24th of August. This is a while back. But about 40% of the portfolio is in money markets and bonds, 39% in US equities. You've got Japan, UK, Europe, China, and emerging markets. So you really get a very good split in terms of the diversification for this fund. And within the equity book, so the second chart here, again, within the, call it the 60% that is invested in equities, is split into all the different sectors, but it's based on our investment strategy, the future investment themes. And the one on the right here is saying the same thing. It's just showing you a split with fixed income and money markets also built in. But again, the idea here is SGF was created to make sure that you have strategy number 1, number 2, and number 3 in the fund. So this is just to show you what also happened over the last 15 months or so. You can see how the different allocations have shifted. So, we started equity a bit lower, and then as we got closer to the US elections, it was sort of risk on. So we sort of pushed up the risk and took up a higher equity weight. And then since then, we're starting to sort of be a bit more cautious of the market. So we've sort of been pulling back. So again, the benefit is you get a fund manager to do all of this for you. You don't have to do anything. This is the performance of the fund since the inception on the 2nd of June last year. So it's up about 24.5% or so from 2nd of June to the 31st of August. And we have a target return of 6% a year, meaning that we're trying to say that we hope to beat 6% absolute every year. Obviously, the last 15 months have been very good. We're up about 24%. So the unique thing about SGF, and this is something that I wanted to bring back from my time in the UK, is that we've created monthly, sometimes it's twice a month, investor letters. So what I do is I sort of like write down my thoughts and the team's thoughts about how are we thinking about the markets going forward and what's happened with your money. So if you go on our website, in the library section, you'll find all of these letters. They're called the Global Strategic Thoughts. And you can just have a read in terms of like, okay, what are we thinking? What's going on? What happened to your money? So over the last month, we talk about, okay, the fund's up 1.5%. Where did that come from? This amount came from equities. This amount came from bonds. Oh, we lost this amount in FX. So you get that kind of like transparency, which I hope is not something that's easy to get. And this is, I'm hoping, our value add for our investors as well. So just to recap then, this is the fund, Global Multi-Asset Strategy. As I said, we invest in all 3 asset classes for you, so you don't have to worry. We'll do the stocks, we'll do the bonds, we'll manage the FX risk. The benefit is I've built in the sort of 3 strategies within the fund. So you've got your asset allocation, you've got your diversification, and you've got the unique investment strategy in there. Okay, so I think that's my 30 minutes and 10 minutes on to Q&A.
Thank you so much, Hisham, for telling us about SGF. And I'm very, very happy to know that the last 2 years have seen tremendous growth for SGF as well. Now, we have a couple of friends who have already gone on slido.com with the room code to ask you some questions. So let's move on to Q&A, shall we?
Yeah, let's do that.
The first question is from Adi. Adi would like to know from you, Hisham, do you forecast a US market correction anytime soon? And if it's not soon, when do you forecast that to be?
Yeah, so this is one of the things that I think the investment community has got very wrong. So I think, obviously, given that this year we've seen one of the best returns in the US market, even in the history of the S&P. But, starting from sort of late June, early July, there was this sense that, perhaps we've gone too far too soon. And in any normal year, you tend to have the sort of 5% usual corrections that happen in the US, but this year we've not had any. So I think that sort of put a lot of people on edge. So everyone's sort of worried about this correction that should or need to come. But since then, we've not seen it yet. So, do I think that a correction in the US will come? My answer is yes. I do think that it's healthy for the markets to sort of correct a little bit, but I don't think it's going to be in your sort of 10 to 15% kind of quantum. It's more likely to be in your sort of 5 to 7%, or we might not even have it. But why I think we might actually see a little bit of a blip is because, the sort of taper announcement, I don't think it'll be a shock because we know that the Fed's kind of like teeing it up. We know that a taper is coming. Likelihood is that it gets announced sometime in November, it starts sometime in December. But what we don't know right now is the speed of how fast, the rates go up. And a lot of that is also dependent on what data comes out on the sort of jobs front over the next month or two. And the Delta variant doesn't make it easy. Obviously, it creates more uncertainty. So again, because of all the sort of different factors here, it's very difficult to say whether we'll have the correction now or next month. But what I will say is that it doesn't feel to me like this is the time that you want to be sort of pushing hard, or kind of like all in kind of thing, because I do think that small correction is coming. But when the correction comes, there is so much cash that's sitting on the side that's going to be jumping into it. So everyone will be buying that dip. And so if you're an investor who says, I don't really want to sort of trade sort of short-term stuff, then I say do nothing. Just continue to hold, because the reality is the US market is growing above trend, and it will do so again next year. You're in a good spot, and it's just too early to be selling equities at this part of the cycle.
Yeah, I think one of the anonymous Q&A participants is asking if we're expecting another global market crash soon. That would be a very difficult question to answer, considering even the CDC is constantly just constantly saying that, oh, we might have like new variants to look out for COVID. And obviously, COVID's not the only factor. But what do you think about this, Hisham?
Yeah, so obviously if we knew when a crash was going to come, I wouldn't be doing this for a living. I'd just be doing something else. But like the reality is this. So the market cycles kind of lasts on average 6 to 7 years. The last recession we had, pre-COVID, was the Great Financial Crisis. So 08-09 until 2020 was the longest period where there wasn't a big recession, a big market crash. Yeah, we had, your sort of garden variety 10 to 15% kind of corrections, but that's just healthy for the markets anyway. They got bought very fast. But but it takes, when you come out of a recession and everything is still growing very strongly, and earnings is growing, revisions are moving up, jobs are being created, and you're not yet at the point of full employment, and rates haven't even gone up. So you think about them. So like take all the central banks around the world, right? They brought rates down because of COVID. We haven't had, the big banks moving up rates yet. Even the Fed has told you the earliest we're going to do it is 2023. So again, to say that the market will crash here when the first rate hike hasn't even happened and the US 10-year Treasury is sitting at 1.3, 1.4%, it's just very unlikely unless you have a very exogenous shock, like perhaps a mutant variant of the COVID, which completely kills 10 times the amount of people that we have with COVID-19, then yeah, sure, your market's going to crash on that. But if you exclude that as a very sort of, that tail risk is really there at the very end, then again, it's very unlikely that the market sort of boom kind of like ends here. It's just too early. We're moving from early cycle to mid cycle. We're not even thinking about late cycle yet. So yeah.
All right. Now, another person asked if there are any limitations, and if so, what are the limitations of asset diversification?
Yeah, it's an interesting question. I mean, people always talk about the benefits, right? Benefits is
exactly, that's what I was thinking.
You're optimizing the returns per unit of risk. The limitations could be sometimes there is, okay, I got it. It's actually a false sense of diversification, meaning that you think you're diversified because you've got bonds, you've got stocks, you've got FX hedges on. But there are periods where correlation goes to 1, meaning that if you think about what happened, this is a good example. March 2020, equities went down, bonds went down, FX went down. So everything went down at the same time. So diversification works until it doesn't. But obviously that was only for the month of March, because obviously the Fed came in, stepped in, backstopped the LQDs, your investment grade bonds in the US. That gave bond investors some comfort, and then bonds recovered, and bonds actually went higher than where it was before the sort of pandemic hit, and equity was down. So then the diversification worked. So there's a short period of like 2 to 3 weeks when everyone was panicking, diversification failed, correlation went to 1, but after that it worked. So again, if you want to say what's the limitation, yeah, probably that.
Now, I feel like there are some questions here that could be combined into one. So I'm gonna try to see if I can put them into a sentence and just throw it at you. All right,
Go ahead.
Hisham. So do you, or SGF for that matter, take into consideration the short-term market movements when it comes to investment decisions? How do you compare, how do you hedge against currency volatility? And more importantly, I think one of the newer questions that everybody was very excited about is that what is the comparisons between, let's say, SGF versus StashAway, for example?
Okay, yeah, okay. So do we take considerations of short-term market movements? Yes. So, like as I said, I'm a bit more cautious of the market. So what I have done is I've reduced the equity exposure, but instead of increasing bond exposure, I've actually increased money markets exposure, because I'm using FX as a hedge. So I wouldn't go into the intricacies of why that decision is made, but you can check it out in my investment letters. But yes, I try and manage the sort of short-term market movements by allocating the different asset classes. In terms of how do we hedge the currency volatility, what we do is we I don't know the right word is buy, but we go into a forward contract where we say we can hedge the foreign currency. Let's say we go short the dollar and we go long the ringgit. In this case, if the dollar weakens as a Malaysian investor, obviously in theory we should lose, but because the forward contract is there, it negates the impact, and so therefore we actually don't lose anything when the ringgit strengthens and when the dollar weakens. So again, if you look at my investor letters from last year, obviously we saw the US dollar weakened a lot from June to December, and the fund was hedged. So we had the benefit of the profits from the hedge offset the loss from FX. So this is one of the benefits of SGF, which is you have a fund manager dynamically sort of managing the FX risks for you. Or sometimes in other cases, you can choose whether you want to go into a MYR hedged fund or a MYR only fund kind of thing. But then that's your decision in terms of how your views of FX. We try and sort of take that decision off you so we can do it for you kind of thing. Sorry, Kevin, the third question was...
The third question has a bit to relate to Stashaway. Someone said, how do you compare
Right.
SGF to Stashaway, for example?
Right, so the difference is this. SGF, the limitation I would say, is that it's got one risk profile, right? It's trying to say that it's one fund, but it's not completely risk adjusting for the investors. Let's say the investor is like 20 years old. So in Stash, that 20-year-old can get the highest risk portfolio, which has got like 100% equities, right? But for SGF, you can't, because it's always going to have the sort of diversification between bonds and equities. So in that case, SGF is perhaps more suitable for someone more in the midlife rather than the early life. But the other difference as well is that Stashaway invests in ETFs, in different exchange traded funds, whereas for us, we're doing it actively. So we're picking out the stocks that we think can do well. And again, the third difference is, if you want to know what SGF is thinking, what is the strategy for the next month, next 3 months, you can pick up our letters, open it up and say, okay, I know what they're doing right now. But with Stash, I guess you can't really know what they're kind of going to do over the next 3 months, because again, it's all driven by the sort of algos and the rules that they sort of set up kind of thing. But in terms of the life of these two funds, they're both designed to be invest today, hold for a very long time, rather than invest today, hot potato kind of thing, where invest today, 6 months, get out kind of thing. And sometimes it works. Sometimes you kind of want to have hot potatoes, right? Like the news in Japan, Japan's been going up, and Japan will continue to go up. Maybe you want to buy Japan and play that macro flow, but then when the music stops, it'll stop.
Yeah. Thank you so much, Hisham. I know that the questions keep coming in, and you did give away a means for them to connect with you on social media during your presentation. And I hope that some of our participants will take this opportunity to talk to you here at the networking event in our lobby as well. Would you mind giving us one last way to reach you for those of our friends who might have more personal or questions that they might want to point directly to you?
Okay, so I guess we'll use the conference. So we have a booth set up. So feel free to visit the Nomura booth. We have people there already. And if you need me to sort of, pop in virtually into the booth, I guess I can.
Yes. That's the whole beauty about having a virtual conference. Thank you so much, Hisham Hamzah.
Thanks, Kevin. Appreciate it.
All right. Bye. Now, ladies and gentlemen, before we move on to the next speaker, here's a reminder about things you have to do at the main lobby. You will find a lucky draw questionnaire. Here's a clue. You've got to make sure you visit the booths to learn more about our partners, like Nomura earlier, and sponsors before trying to answer the questions. You must complete the questionnaire in order to participate in the lucky draw. Now, getting all the answers correct will put you in the running for some very, very attractive prizes during our lucky draw at the end of today. Do note that the questionnaire submission for lucky draw will come to an end at 4:30 p.m. So you've got 2.5 hours about there to sort this out. In the meantime, I would like to give you an introduction about our next speaker, Belkazi Taufik. He is the head of investment specialist and project management office at Maybank Asset Management, Sendirian Berhad. Belkazi joined Maybank Asset Management as the head investment specialist and project management office back in June 2018, and he's responsible for leading the investment specialist team as well as executing the firm's projects and strategic initiatives. He was previously the associate director in UBS Investment Bank Kuala Lumpur, where he was part of the equity sales and trading team and managed the firm's institutional clients. Belkazi has 10 years of experience in the financial industry, where he started his career in Malaysia as an institutional sales dealer with TA Securities Holdings Berhad and MIDF Amanah Investment Bank Berhad. Here to talk to us about dynamic mixed asset strategy to generate returns while managing downside risk. Please help me welcome Mr. Belkazi Taufik.
Thank you, Kevin.
Do you
Sorry, you were saying something. It was on mute. Okay. Thank you so much, Kevin, for the introduction. Good afternoon, everyone. Thank you for having us today. So, like Kevin said, I'm just going to talk about to the mixed asset strategy, right? More on the dynamic sense of things. So the question here is, how do you want to generate returns, especially now where it's a bit unsure while managing downside risk? So just to kick off what I'm going to talk about. A dynamic mixed asset strategy could basically very simply capture opportunities on the upside while protect the downside risk for your portfolios, right? And with our strategy that we're going to talk about a bit in detail later, we do have a flexibility to adapt to different market environments with the right mix of assets. Theoretically, on a daily basis, but of course we don't do that. But the portfolio does have that ability, right? So basically, in a nutshell, I mean, people talk about asset diversification, talk about trying to allocate different money assets with your money, but this fund or this strategy of a dynamic mixed asset strategy will let the fund managers do it for you, the experts, right? Rather than having it to do it yourself. So I'm going to talk about what we think about the market. So basically, how we are positioned in this current market conditions, and basically have a bit of a color on how we are going to manage our portfolio, although this is a very nimble, very sort of a dynamic, flexible sort of asset allocation, but we do have a long-term view as well. So first and foremost, of course, very simply, I think global growth recovery. I think everybody in this conference will be talking about that, whether it's in 2021 or 2022. But for us, we are quite positive for the economic growth. This is the main part for our thesis, not only for this fund, but at Maybank Asset Management across our portfolios. We're not ignoring the noise, but we're discounting it, right? So we're expecting global growth for 2021 is still about 5.9%. In 2021, but what's more important is what we want to look at in 2022. So we do think that this year the growth is being driven by the developed markets. I think everybody knows that. But in 2022, where the shift of the growth will be more to the emerging markets, the Asian markets, but in totality, a 4.5% growth is also expected for 2022. So it's still quite a healthy sort of growth expectations here, where we want to be positioned in our portfolio, right? And a couple of reasons for that, right? So one, of course, the successful vaccine rollouts. We've seen this year, mainly in developed countries. We're starting to see that in this part of the world, the Asian market, the emerging markets. We've seen that, and we've seen what kind of results it has given, right? Of course, there are concerns about inflation, but vaccine rollout will be one of the key factors of a growth expectation that we have. Secondly, yes, there is a concern about Fed tapering. There's a concern about increasing interest rates, but we do think across the globe, in pockets of where the countries are, policy support from government and central banks would still continue, right? Even for the Fed, yes, they're planning to taper by the end of this year, but they're not going to taper and increase interest rates at the same time. So that's our expectation. Yes, they will do it, some sort of it, to control some inflation concerns, but in general, I think they would probably be more supportive towards growth rather than trying to stunt the momentum, basically. And thirdly, what we want to look at, or what we've seen, at least from the second half last year, the companies that we invest in are the adaptability of firms operating under these new restrictions, right? Even for us now, we're in this conference virtually. The last time I was in a Philip conference was in a physical event. This time it's more efficient. I can reach out to more people. So the adaptability of these firms are one of the factors as well. So the companies that we want to invest in are also growing in terms of how they adapt, how they survive, and how they are successful post the COVID-19 pandemic, even managing the COVID-19 pandemic today, right? So on the right here, you see some of the expectations on different parts of the world in terms of economy for this year, second half of this year, that you're going to see in 2022. So healthy growth. But you will see the momentum will be slowed down a bit in some of the developed nations, but it will be taken over by more of the Asian emerging markets developments as well. Okay, and the things that the thing that everybody's talking about this year, I think probably not so much in the past couple of weeks, but inflation, right? So inflation is expected to spike. We've seen it. We're expecting it to happen. Higher commodity prices, supply bottlenecks are spiking all this inflation, but it should prove to be temporary. We do not think this is going to be a continued thing. More and more with this Delta variant, it might be there might be some concerns on that, that inflation would not be as hot as people might think it is. But even without that, we do think this is quite normal. Why do we say that? Because post-recession, a rebound in inflation is quite common. We've seen it before. It will spike the first 6 to 12 months even, but it will moderate in the longer term, right? So we've seen that back in 08 or 09 during the GFC, right? So now when we see commodity price increasing, the supply chain bottlenecks, it's expected this inflation is going to be spiked because the supply are not able to meet with the demand. So when the supply demand will just push the prices up. So that happens in a recovery sense of things. But we do see that trend tapering a little bit in some of the developed markets in the US on the inflation side. But of course, as vaccines start to roll out in the Asian side of things, in the emerging market side of things, you will see that inflation spiking up. But again, it won't be sustained, right? So we've seen it before. Before even we got into this recovery thesis back in 2020 when we were going into positioning our portfolio, we were expecting this to happen already. So we're not surprised by it, and we are firm believers that it is not going to be sustained over the longer term. So it's not going to be a big part of our investment thesis. Recovery, earnings growth will be a bigger part of how we're going to manage our portfolios, especially in the dynamic asset allocation perspective. Okay, and having said that, just to touch a bit on this is how then will the Fed respond? Yes, there are news, people are reacting to it. The best thing is people are pricing it already. So yes, they are probably going to be tapering by the end of 2021. We're expecting that. Markets are pricing that already. But in terms of interest rates, probably the end of 2022. But whatever it may be, yes, it might be a concern for certain parts of the world, certain parts of the markets even, right? So let's say this will impact the equity markets in the US or the bond markets in the US, but there are opportunities even in the Asian markets, Asian equities, Asian bonds. Asian equities is still lagging, right? The developed market. So there are opportunities there. Asian bonds, yes, bonds are not as attractive probably in the developed markets. Asian bonds, very attractive still, especially in the high yield space. So there are opportunities there. So the Fed will respond. We're not ignorant of that. Globally, other policymakers, other central banks will respond, but it would be more gradual rather than too fast, just to make sure that it happens, basically, right? And this is what we want to be looking at. We've been looking at it. We're no longer looking at number of cases. We're looking at number of vaccines, right? The vaccine has been rolled out, and countries with higher vaccination rates have shown progress, real recovery that it is on track. We've seen how it's being rolled out. And by the end of the year, if I can say that 70 to 80% of the world's population are expected to be vaccinated. At least the ones that could reach vaccinations, right? So we are expecting most countries to do this, and this would be a good main factor of the economic growth, of the earnings growth, and how we are positioning our portfolios for our investors today. So this carries more weight than the noise with inflation, with tapering, with interest rates. So this is going to be something that we'll be focusing more on. Okay, and reason for that is because we've seen that the recoveries has been on track in countries like the US, the UK, where spending post vaccination coming up at a certain level, post easing of lockdowns, spending is back to pre-pandemic levels, right? So we've seen that already, and consumer confidence are also improving significantly once people start to go out. There's pent-up demand. There's a lot of savings from the pandemic. Yes, there's a boom and bust sort of argument where people start spending so much and then they will bust, they won't spend anymore. But what's more important here is that people definitely will continue to spend. Manufacturing companies will continue to supply. All of this shows that if you go back to normal, the vaccines can provide you with that normality, normalization. Recovery will be on track. So we've seen it in the developed nations. Now we're going to see it in Asia. We've seen a bit here in Malaysia now. We're going to see it more and more. Okay, even in things like we partner with Schroders, and we saw things like restaurant bookings. When the lockdown eases back probably in April 2021, in some parts of the world, first goods, people consuming goods were seeing a lot of demand, a lot of purchases. And after that, they move on to services, right? Restaurant bookings, for example, traveling, for example. We've seen that. So meaning that people want to spend, they're dying to spend, they have money to spend. And yes, that will cause inflation to be a concern, but it will normalize once supply meets that demand, right? So again, we are very positive on a recovery. We are aware of a Delta variant in the COVID-19 cases. Yes, we know all that, but what we're looking at are more on the growth of the countries, growth of the economy, growth of the company. So that's where we're looking at, and vaccines and this recovery thesis is going to be a main part of our portfolio management, right? And because of that, because of where we see the economy, the earnings are going to be in the next couple of years, we do have a preference for equities. Right? As a house, our preference are more towards equities, whether it's global or Asia. We have a preference tilt towards equities, and because we have a very positive view on earnings, right? US, UK, Europe, ex-UK, Japan, Asia, and EM, we have a positive view in 2021. We've seen that already. We've enjoyed that. Hence, you see the markets has been quite positive in responding to equity markets this year. Not so much in Asia because of the China story, but a lot of things in the US, in the Europe, in the UK, you've seen that already. In 2022, earnings projections on our side as well, we're expecting to be quite positive. Hence, we do have a preference for equities. So in terms of where we look at things, equities versus fixed income, we prefer equities. Within equity space, global developed versus Asia. Now we are more positive Asia. Even for fixed income, we're not positive in totality. But if you were to compare with the global and Asia, we prefer Asia. Sukuk, we are really positive, and we do like Sukuk. This fund that I'm going to talk about has a lot of Sukuk exposure because it is a Sharia compliant fund. So we like Sukuk, we like Asian fixed income as well, particularly on the high yield side. So again, everything looks expensive, if I can say that. Everything looks stretched, but there are pockets of opportunities, right? So that's why we have preference, but we do see pockets of opportunities in the areas that we are less preferring as well. So on that, this is what I want to touch on, which is nothing looks cheap these days, right? So you've been investing in the markets for some time now, and you see today in 2021, nothing looks cheap. Whether it's bonds, whether it's stocks, everything looks expensive. Whether it's US stocks or even Asian stocks, historically, it's expensive. But what we want to look at is the earnings. We do think the earnings could justify the current rich valuations. Of course, it's not all over the markets. It's quite a pocket in terms of where the earnings could justify the rich valuations now. But if you are trying to invest today and you're worried about valuations, then it'll be a problem. You probably wouldn't have ways to invest. But in terms of valuations versus the earnings that these companies can probably produce over the longer term, we think it's fair. There are opportunities for us to look at, right? So if you look here in terms of valuations, yes, the US, ex-US, expensive, but there are still opportunities there, okay? And the source of returns in terms of where our thesis has been based on is, again, earnings rather than valuations, right? So we look at earnings because we do think earnings is going to be driving the performance of this share prices in the next couple of years, right? So if you look here, we've seen it already, that dark blue line, the dark blue portion of the charts are all EPS growth. So they have contributed most in most part of the world in the year-to-date returns of the stocks, right? So we do think this trend will continue rather than the sentiment valuation that's driving it. Yes, you have some positives here and there, but the fundamentals of the earnings will probably be the bigger factor here. Okay, and global profits have turned, right? So across equity regions, there are a lot of profits already that's been recorded that has been providing to a more positive earnings growth expectations as well. So we do expect it to continue. We've seen it more in the developed markets, of course. We're going to see more and more coming in the Asian side of things as Asia starts to recover even more. Yes, sentiment-wise, it's being dampened now because of the China story, but in Asia as a whole, we do think there's a lot of earnings growth potential, whether it's ASEAN, whether it's India, but all in all, earnings growth will be driving the returns of the share price. Okay, I'm not going to touch on this. I think this is more detail on where the sector returns is going to be. In the interest of time, even when it comes to yield, if you're looking for yield, we do think that equities would be the best way to get some income over the next at least 12 to 18 months, because the equity dividends versus the bond yields looks more attractive. But if you do want to look into bonds, we are looking more on the Sukuk side of things as well as the Asia fixed income side of things. But in general, if you ask me, hey, equities or bonds, when it comes to income, at this point of time, risk reward wise, equity looks a bit more attractive. So even when it comes to yield, equities is more for preference rather than anything else. Okay, so that comes to this fund. So that's the view, right? You understand that we do look at different assets. We do think there are pockets of opportunities for this current market conditions. So our fund, Maybank Global Mixed Assets I, or GMI, we like to call it short, it's a fund with a dynamic asset allocation strategy, right? Basically, it's a Sharia compliant fund, yeah, to capture opportunities while protecting against the downside risk. So we invest the portfolio in global Sharia equities, global Sukuk, other Islamic diversifying assets, money market, gold ETFs, REITs, and even cash. Right. So we work with Schroders. It is our investment advisor, but we do manage the fund ourselves. But Schroders is the investment advisor for this. So just to highlight the features of the fund, the fund has a 6% target return approach, right? With the dynamic asset allocation, the goal here is to reach at least 6% per annum. It's a global fund, so you have access to global opportunities. And the unique thing that we try to do for this portfolio together with Schroders is to have stable returns. We understand that there are funds that could give you sexier returns out there, but what we're trying to do here with a dynamic asset allocation strategy is to give you that stable return, something more predictable, capture the upside opportunities, protect the downside risk. So that's how we're managing this portfolio. Okay. So these are 4 key points of the fund. In interest of time, I have about 10 more minutes. 4 key points. One, why I want to talk about this fund is because the fund has outperformed the target since its launch. We launched this back in 2019, and it has done very well. It's one of our top selling funds with Maybank Asset Management, and it has done about 15% per annum since its launch. Secondly, when I say it's a dynamic asset allocation, it is responsive as such, meaning that theoretically, there's a lot of funds out there says they are dynamic, but they do it on a monthly basis, quarterly basis, weekly, bi-weekly basis. This theoretically can be done on a daily basis if it needs to. It's because we have the ability, the team, leveraging on a global team to do so. So since we've launched this, we've asset allocated drastically about 14 times over the past 22 months. So we've done that, and we are going to continue doing that. Thirdly, in the respective asset class, the main asset classes is Sharia compliant equities as well as global Sukuk. There's a high alpha stock and Sukuk selection, basically to drive returns and to provide stability, right? And today, the fund, being nimble, has been positioned to capture one, the long-term growth, so sort of a barbell strategy, but quite dynamic in that sense. We want to capture the long-term growth. We want to capture today's growth, meaning cyclical and value plays, but in the same time, valuations is not going to be a key determiner on how we're going to position the portfolio. It's more of how we take opportunities to capture the longer term growth, basically, right? So if you look at the performance of the fund, this is as of July. I apologize, but we do have performance as of August as well. It's quite strong, but since inception back in 2019, the fund has done about 15 to 20%, depending on the asset class or share class that you invest in, whether it's ringgit, US dollar, or ringgit hedge, right? So depending on the share class, but it does 15 to 20%. Again, The target is 6% per annum, and we've outperformed that. And year to date is already up about 9 to 14%, again, depending on the share class that you invest in, right? Outperforming the benchmark. So it's because of the dynamic asset allocation and the way we manage equities and the Sukuk portion as well, right? So it's a best of both worlds things, asset allocation to make sure it works within different market conditions, and within the asset classes, how we manage it, how we strategize. That's how we have been providing this kind of returns to our investors, right? And in terms of dynamic asset allocation, this is the idea. Different market conditions, these are not fixed. Yeah, this is an illustration of how the asset allocation is going to be in times of expansion. You'll probably see more equities, some in Sukuk. In a slowdown, we can shift it quite fast. If there's short-term opportunities, we can be tactical about it, change it daily, weekly, quarterly, whatever it may be. The goal here is to seek the right mix of assets to perform through all market environments, right? So we do have that ability. So for example, last year after the pandemic, we were up about 40% in Sukuk, only 30% in cash, and let's everything in equity just a little bit, and then we can shift very fast. So hence why it's quite responsive, and we are able to generate those kind of returns. Okay, and when I say that, again, I'm not just saying that as a theory, as a marketing pitch. No, we actually did it. This shows, of course, the slide is shared in the lobby there. You can access it. This is how many times we have shifted the significant movements, of course, since we launched back in July 2019, right? 14 times in 22 months, and we will continue doing this because market conditions are as such. Okay, and in terms of asset allocation, how we are managing to do this is because we work with Schroders, which is our investment advisor for the portfolio. They provide us with the advisory in terms of asset allocation, and while working with them, we are able to leverage on a huge amount of resources to manage this portfolio. So there's 100 investment professionals across 6 locations worldwide, just looking at multi-asset, right? So they are able to look at macro, micro data, company data, and basically come up with advisory to us on what kind of asset allocation that it will be, signals on a daily basis if it needs to be done, right? So we manage to have that kind of access, hence why we are able to do a dynamic, flexible, responsive asset allocation for this portfolio. Okay, and in terms of alpha, in terms of the equities, yes, we do work with Schroders as well. They are the global experts here, but the idea here is we want to have a more high quality sleeves in the portfolios, capturing the growth, and the other part is to capture more tactical opportunities. I will show that in how we do this in sort of times. For example, as of July, we have been positioned to capture those opportunities. Like for example, we are overweight in tech because we want a long-term structural growth for the portfolio. But we do have some overweight in the current cyclical value plays, not as much as what we did before. We had more before this, but since it has shifted away from purely value to growth now, it's a bit of mix. We can capture both in this portfolio, whether it's from equities or even to a certain extent, if we can do it via Sukuk, right? So we can do that for you, right? So currently the allocation about 65% in equities because we are positive more in equities. Global Sukuk is about 150 portfolio. Reason being is because we want to provide a bit of stability. Global Sukuk is a bit unique because first of all, the yields are very attractive now, and Global Sukuk does have a negative correlation with the US Treasury, so it does provide us a bit of stability in terms of the portfolio. But hey, if things get better, we'll increase on the equities portion. Okay, so these are just some of the things as well that we want to do just to wrap things up for the Q&A. The reason I want to highlight a dynamic asset allocation is because yes, we are positive in equities, but there are risks surrounding the world, right? So we're not sure where that direction is going to take us. Yes, you must have the equity funds. Yes, you must have a fixed income fund. But if you're unsure, this kind of strategy allows you to be in the market quite consistently and let us basically manage where to position the portfolio, whether it's to the equity side, whether it's the Sukuk side. And then this is a Sharia compliant fund, so it works for everyone, and the asset quality, because of the Sharia compliant screen, is even better, right? So that's all I have, and I'm happy to take any questions, Kevin. Thank you.
All right. And Belkazi Taufik, as a lot of you know, is the head of the Investment Specialist and Project Management Office at Maybank Asset Management, Sindran Berhad, which means I'm sure a lot of our friends right now are dying to ask you a few questions. So let's take a look at our Q&A, all right? There are a couple of top questions, and the first one is, actively adjusting portfolio allocations in response to changing market circumstances might be time consuming and expensive. How does a fund manager handle this?
It is time consuming. It is expensive, right? But because we do leverage on a global asset manager like Schroders, because they scale this multi-asset expertise, so we are able to leverage on the global sector specialist, the economics department globally, so to basically give us those signals on a daily basis. So it's quite systematic. We do have an official meeting with them on a bi-weekly basis, but we can do this on a daily basis even. So the reason we are able to do that is because we partner with a global house that has scaled this part of the business. That's the main reason. Hence why we want to offer this to Malaysia.
hmm One of the very interesting thing that I was listening to your presentation, and I loved listening to you talk about the dynamic asset allocation. So thank you for that. And I'm sure some of our friends will bug you a little bit more when they can visit your booth as well. But for
Yep.
now, anonymous asker is asking, if it's in a bull market, how do investors' portfolio have the highest exposure to momentum, and how does it reap returns?
In a bull market, you will see a lot of these dynamic asset allocation portfolios like ours will be bulk in equities, right? Again, even in equities for us this is a good example of how we read that kind of returns, because the first quarter, probably the first 2 quarters of the year, you'll see a lot of value plays. So the fund, because it is big enough now and also is leveraging on a big team globally, it was quite overweight into the cyclical side of things. And when it needs to shift, it'll shift straight away, very fast. In an equity space from value to growth, we've done it very efficiently last year, because you've seen how fast the market turned last year. So in that sense, you will see portfolios like this will be bulk in equities, and within that equities, the region, the themes would be quite nimbly managed, basically. Yeah.
Hmm. Now, when someone asked when the crash comes, what is the key parameters and support that you'll be looking at on Nasdaq 100 and S&P 500?
When the crash comes, when the crash comes, okay, of course we didn't know when it was coming. We'll be quite honest with you. We were impacted, but the best part about this portfolio is that it didn't show so much. I think probably some of the panelists talked about this back in March, where every single market dropped. So it's very tough for us to choose which parameters to look at, because everything was pointing south. But the key parameter when we look at how after the crash was, of course, at that point of time, was valuations. We were able to stomach that kind of valuations uh, entry, because it was cheap, right? So because we do have an ability to liquidate our assets pretty fast from the sukuk portion as well as the equity portion. So when we saw the signals of some sort of recovery in terms of at that point of time was probably more towards earnings in some of the tech companies, we were very fast in buying those companies. So again, we didn't see signals straight away when it was crashed. I think if we did that, please let me know how to do so. I would love to talk to you. But after the crash, the signals of where the companies or which type of companies are going to perform better, we've seen it quite fast. And at that time was more on the tech side of things.
Now, when it comes to evaluating company, what parameters do Maybank usually set when it comes to evaluating companies that have adopted to accommodating the new SOPs in the new normal?
It's a lot more. So, for example, some of the things that we do look at, I've been working with Schroders actually. We do look at some qualitative data nowadays, not only just quantitative. Some qualitative data such as the impact of certain businesses. For example, yeah. So let's say tobacco companies. If you want to invest in tobacco companies, we don't anymore. We don't just look at it as tobacco companies earnings great, fine. But what is the qualitative and what is the quantitative cost of that qualitative factor? How much of a impact or money spent in medical when it comes to smoking, for example. So we do look at other things, just not just financials. That's something new. To be honest with you, I myself, we still don't understand how it's done in a totality basis, but qualitative factors are being put into our evaluations now as well, in terms of identifying which companies we want to invest in.
Okay. Now, Belkazi, today's event, we've obviously got financial managers, we've got people in training, and we've also got some of the people in public, and the questions can be very varied at times. So the next one I have to ask is, normally, how frequent should we review and re-optimize the holding funds?
Generally, I mean, for us, we do see it in depending on your risk appetite. But generally, if you're a new investor, quarterly would be optimal. Because generally quarterly you'll see significant movements with the results and everything like that. Quarterly would be great. But again, if you're unsure of doing rebalancing, re-optimizing your portfolio, let the fund managers do it for you. I think there's a lot of either dynamic asset allocation like us or quarterly asset allocation funds out there. Let them do it for you, or a financial advisor from Philip, they can do it for you. So generally we'll suggest quarterly. But of course, if you're more high risk, you want to capture opportunities faster, some people even do it monthly.
Oh,
Yeah.
okay. This is, I'm not sure who asked this, but a fund's performance, while it may have to do with the market forces, how would a manager skill be a contributing factor?
The experience does count. I mean, that's the big difference with for example, if you look at some of the robo advisors will have a lot of the a lot of the returns, but it's basically very passive, very market driven. But in generating alpha, the manager's skills are important because they do have the ability to analyze the stock, the company, just not by its face value, right? There are other things as well that they can look at, and also experience. So some of the companies, even though they perform well in certain market conditions, or vice versa, they perform very bad in the market conditions, but over the longer term, because of this experience, they know how the management is, how the business is. That's where they can add value to the portfolio. Market forces, yes, will make sure that the returns will be bad or good. But again, the fund manager's experience, fund manager's analytical ability will add alpha to the portfolio.
That sounds really nice. Thank you so much. I think we have time for, we might only have time for one more question, but Teo Eng Hong said that the US market trades on 22 times PE versus historical average of 15x. So surely all the good news is priced in here, and yet the market is too expensive.
Yes, the market, it is expensive. Like I mentioned just now, nothing is cheap nowadays in terms of where the market is. So in the US, we're very selective. We are aware. So what we do for the US and even UK actually is looking at high quality companies that could provide a bit of earnings justification when it comes to the price that they are at today. But in terms of preference, US, the unique thing about US is we do still have it, especially on the tech side of things, because of the liquidity factor of how the US market is. But yes, valuations are expensive. So when we want to invest in equities today, I'm not saying long term, but today we're looking more towards the Asian side of things because valuations are attractive. So US, yes, expensive, but we look at very specific companies. But broadly, US, Asia, we'll look at Asia instead.
All right. I believe we're running out of time already. So for the final question, perhaps they can head on over to the virtual booth and see if they can find some answers there. In the meantime, thank you so much, Belkazi, for explaining so much about, especially dynamic asset allocation and how it works in Maybank Asset Management for us.
All right. Thank you.
All right, we've done with the Q&A, and right now we actually have our next speaker. When it comes to investing, most people focus on the returns and always try to either forget or overlook the risks. So when they chase after the higher returns, they often take up a huge risk to achieve a higher return. So higher risk means higher uncertainty, right? And higher uncertainty means the possibility of getting a return could be very low. So when they're chasing high returns, that is the first step into possibly huge losses. So as an investor, we need to look into the risks, manage our risks, lower our risks maybe, instead of just focusing them on just one thing. Alex Ng, the master speaker and trainer of 8VI Malaysia Sdn Bhd, is here to talk to us about low risk, high return strategy to profit from any stock market. Alex, the screen is yours.
Thank you, Kevin. Thank you, Kevin, for your kind introduction. Thank you so much. Hi guys, good afternoon, everyone. Now, Alex here. Now, first thing first, I give you about 5 to 10 seconds to take out your phone, the QR code to scan the QR code here, so that you're able to actually download the note that my presentation for today. So today I'll be sharing with you, okay, how you can actually manage your own investment portfolio to increase your return, right, from a 6%, 5% to about 15 to 20%. Okay, now of course I understand that some of you, maybe you see me before, maybe some of you this is the first time that you're seeing me, so please allow me to actually have about 3 to 5 minutes to do a quick simple self-introduction, so at least you know who is this person talking to you. I think that's pretty important, right? So now hi, my name is Alex. If you see me before, hi, good to see you. And of course, if this is the first time that you're seeing me, hi as well. So today I'm a speaker, trainer and coach, teaching people just like you how to invest safely, generate good investment results. Now, before becoming a speaker, trainer, and coach, I used to be an auditor from Deloitte. Now, just in case if you don't know Deloitte, Deloitte is actually one of the big 4 accounting firms in the world. So we have Deloitte, KPMG, Ernst & Young, and PwC. So I was from Deloitte as an auditor. Then later on, I switched my career to join an investment company managing a $20 million fund. Then later on, I decided to switch my career again to become who am I today as a teacher, teaching people how to invest. Now, a lot of people ask me, Alex, why do you want to switch your career from a high-pay, stable income job as a fund manager managing $20 million fund? Why do you want to switch your career to become a teacher, right? Well, the reason is very simple, because I realized a lot of people, they know investing is very important. However, they do not know how to invest properly. So since I know how to manage my own personal fund, I also know how to manage my company fund back then. So that's why I decided to actually switch my career to really teach and share with people how they can also manage their wealth as well. So I switched my career about 4 or 5 years ago. Since then, I traveled quite a bit. And back then, during COVID, I still can meet you guys face-to-face. But right now, because of COVID, and of course, thanks to technology, I still able to actually meet you guys via online. So I travel quite a bit, okay, not just in Malaysia, Singapore. I also travel to US, UK, India, different places, China, Hong Kong, big stages, 1,000 people, small stages, 100 people, to actually share my knowledge, my skills, so that you guys can also invest safely, generate good results. And of course, other than that, personally, also very blessed, have this opportunity to share some of my views and opinions and some investment opportunities with certain press, the Chinese press, English press, right, The Age, Malaysia Kini. And again, today also want to thank Phillip Capital for this opportunity to be here to actually share with you guys as well. So yeah, this is a quick, simple self-introduction, and glad to be here. Now today, my intention is very simple. Okay, I want to share with you 3-step process that can help you to actually boost your return from about 6% to 15 to 20%. Okay, so how to do it? How to do it? So because my session today is about 30 to 40 minutes, right? I'll be speaking a little bit fast. Right? So if you have any question, you can just drop down your question, and I'll be able to answer you accordingly later on. Okay. Now the first step, in order for you to be able to generate the good return that we all deserve, is as obvious, right? We need to find the strategy that has a proven track record. Would you agree with me? I mean, will you dare to use any strategy if there's no proven track record? I doubt you won't. Why? Because you are investing your hard-earned savings, hard-earned money. Would you agree with me? Since we are investing our hard-earned savings, hard-earned money, I think proven track record is extremely important. So what is a strategy that has proven track record? Okay. Now, I believe you know this particular gentleman. His name is called Warren Buffett. Right? He says this, we simply want to buy a great business at a reasonable price. And in fact, he says this, price is what you pay, value is what you get. Now, why do I bring up this particular gentleman, Warren Buffett? Right? He is one of the richest men in the world, the richest investor in the world, and the company that he owns, okay, is this company called Berkshire Hathaway. Now look at the share price. Okay, as of September 7, a few days ago, about 4 days ago. Look at the share price here. One share, 1 unit, right, costs us about 420,000 US dollar. Wow, a lot, right? If I convert to ringgit, it's about what? 1.6 million. And how many of you realize you need to sell away your house just to buy one share, 1 unit? 1 unit, not one lot, 100 shares. No, 1 unit, right? 1.6 million. Some of you probably thinking, wow, even I sell away my house are also not enough. Would you agree with me? Right? Now, if you invest in Berkshire Hathaway, okay, Warren Buffett's company, back in 1965, okay, invest just 10,000 ringgit. Invest really, go to sleep. By 2020, right, your 10,000 become $100 million. During these 55 years, your investment return grow 20% every single year. Impressive, isn't it? Now, why do I actually bring up Warren Buffett? Okay, 2 reasons. First reason is this. We all know, okay, Warren Buffett today is about 90 plus years old. 90 plus years old, still using the same strategy that you have been using for the past 50, 60 years. Now, what does it mean? Right? It actually tells me the risk appetite that he can take at 90 years old, which means, right, 90 years old, his risk appetite is not as high as 20, 30 years old. Would you agree with me? Right? But yet, he's still using the strategy, which means the strategy that he used is low risk. Would you agree with me? Because his risk appetite is not very high, right? And second thing is this. He has been using the same exact strategy for the past 55 years. In fact, for the past 67 years already, 60 to 70 years already, even before he acquired Berkshire Hathaway, right? He had been using this strategy for the past 60 years, which means what? Since 30s, he has been using the same exact strategy for the last 60 years. Means what? This strategy that he used, not just low risk that he can use for the rest of his life, at the same time, it able to generate consistent and proven track record. Now, you can ask me to learn from anyone, anyone, right? Mr. A, Mr. B, Mr. C. I would love to learn from anyone. But first thing first, please prove that that person's result is much better than Warren Buffett. If you cannot prove to me that his result is much better than Warren Buffett, I think we should all learn from Warren Buffett. Would you agree with me? Right? If someone able to generate, let's say for the past 56 years, 21% every single year, I learn from him. I don't learn from Warren Buffett. Right? If anyone can generate, let's say for the past 60 years, he make about 22%, then I learn from a person. I wouldn't learn from Warren Buffett. But at least until today, no one actually beat Warren Buffett results. So I think Warren Buffett's strategy is safe to use, right? Doesn't matter at what age group. Doesn't matter whether you're 20s, 30s, or in fact today you are 80s, 90s. This strategy works for you. Low risk, at the same time generate good consistent results. So what is the strategy that he used? The strategy that he used is this strategy called value investing. Now, I believe, some of you maybe heard of this strategy before. Some of you, maybe this is the first time that you are heard of, right? Now, if this is the first time that you heard of, it's totally fine. For those, who heard it before earlier, good for you, good for you. But today, I need to let you truly understand what is value investing all about, so that you're able to invest with low risk and able to generate high return, high results that you deserve, right? Now, let me ask you a question here. Okay, let's say you want to buy this house. Okay, it's your dream house. Okay, you really like this house, and you realize the property value of this house is 1 million ringgit. Now, my question here is this: would you pay to buy this house if the seller is selling you for 1.5 million ringgit? I believe, most of you here, the answer will be a no, right? Why do you want to pay 1.5 million to get something worth only 1 million? Why? Because that is overvalued. Right? I mean, why do you want to pay 1.5 to get 1 million, right? Now, if the seller is willing to sell you the house with the value of 1 million, selling you at 700,000, would you buy the house? You will buy. And maybe you ask the seller, do you have another one? Would you agree with me? Right? The more you can find, the more you buy. Why? Because you're able to buy it at under value price. Now, very often, the investor always asks us, right? Ask me, Alex, how to know when to buy, when to sell, right? Listen carefully. And in fact, write down your notes. As an investor, we make our buying and selling decision based on this thing called value. Okay? If the price is above the value, we don't buy because that's overvalue. If the price is under the value, okay, below the value, then only we buy because that is undervalue, right? Now, property got value, stocks, equities, business also got value. Okay, you must understand when we invest in stocks, when we invest in equities, behind every stock, behind equities, there is a business. So how does business generate value, right? Now, let me show you an example. So let's say this is a business, right? Every business will sell certain products and services, right? And of course, when they sell certain products and services, they will make this thing called money, right? Revenue, profit, cash flow. And because they make money, that's why they have value, right? If they don't make money, or okay, if they don't make money, they shouldn't be a business lah. So a business, they must make money. The more money they make, the higher value they have, right? So the lesser money they make, the lesser money, the lesser value they have. Okay, so as an investor, right, stock investor, equity investor, we make our buying and selling decision based on this thing called the value. If the share price is above the value, we don't buy because that's overvalue. But when the share price is below the value, then we buy. Then because that is undervalued. So let me give you an example. Okay. Now in Malaysia, I believe every one of us here, we know this particular company called Plus Toa. Now this company is no longer listed in Malaysia. I just use this because for simple illustration, because all Malaysians we definitely go through one of these before. Doesn't matter whether you know how to drive or not, right? Now this business doesn't matter. Okay, good day, sunny day, or rainy day. I believe as long as you pass through the toll, you need to pay. Would you agree with me? Right? Doesn't matter whether during that day got jam, no jam, got lockdown, no lockdown, right? As long as you pass through the toll, you need to pay. Now, what does it mean? Means what? Means the business make money. Yes or no? Now, because they make money, that's why they have this thing called the value. Now, let's assume you know how to determine the business value. And you realize the business value for this company per share is about 1 ringgit and 50 cents. Okay, 1 ringgit and 50 cents. Then you compare with the share price. You realize that the value is 150. The share price right now is trading at 3 ringgit. Okay, 3 ringgit. Would you buy the company right now? Will you invest in the company right now? You won't. I mean, why do you want to pay 3 ringgit to get something worth 150? It's just like you won't pay 1.5 million to buy the house, where the house is only worth 1 million, right? So you don't buy because that's overvalued, okay? Now, let's say for whatever reason, COVID happened, right? Whatever lah, okay? The share price crashed, okay? From 3 ringgit, drop to 1 ringgit, okay? But yet, the business still making money, you know, because as long as you pass through the toll, right? Doesn't matter rainy day, sunny day, right? Got jam, no jam, right? As long as you pass through the toll still make money, right? So the business value maintained, okay? But the share price, for whatever reason, dropped from 3 ringgit, dropped to 1 ringgit, okay? Right now, would you pay 1 ringgit to get something worth 1.5? I bet you will. Why? Because this is undervalued. It's just like you pay 700,000 ringgit to buy the house that is worth 1 million because you buy it undervalued. So now can you see how to make buying and selling decision as an investor? Doesn't matter whether it's property investor or stock investor, right? We make our buying and selling decision based on this thing called business value. And of course, how to make big money. We only invest when it's undervalued. Now, what do I mean here? Now, let me go back to the property example. Okay. Now, let's say the value of a property 1 million and you successfully buy it at 700,000, right? And you realize this particular property, every year, right? Every year, the rental income able to increase. So every year, the rental income increase. Now, what does it mean? When the rental income keep on increasing every single year, means what? The property value will goes up. Okay. Now, if you find any property rental income increase every year, but the value comes down, please tell me, I will buy. Right? But the thing is this, when the rental income every year increase, the property value will goes up. And what does it mean? Property value goes up, property price will goes up as well. So that's how we make money. Now, same thing goes to business, right? Now, when we actually buy under value and the business make money, okay? Now, when the business make more and more money every single year, okay? As the company make more and more money, the business value will goes up. When business value goes up, the share price will goes up as well. Understand? So this is the concept, okay, of value investing. So this is how we able to invest safely, generate good results. So this is step one. Step one to identify a strategy that is safe, able to generate good consistent results, proven track record. I think that's very important. So after step one, what's next, right? How do I generate the results, right? You must understand, skills and knowledge, not power. Skills and knowledge at the end of the day is just information, right? We need to apply the information. I think we need to take massive action, okay, to actually apply the strategy, because after learning a strategy, if you don't apply it, it doesn't work, right? You won't generate the result that you deserve. So step two, you need to apply. Okay, you need to apply. But maybe some of you might be asking, but Alex, stock market is so risky, right? Right? So, I mean, every day the share price up and down, up and down, up and down, right? It's just like gambling. Okay? How many of you heard of such saying before? Okay? Now, would you agree with me? Everything in life, there's risk. Now, what do I mean? Right? Even if you drive on the road, there's risk, right? Why? I mean, definitely got accident happen, that kind of thing. But maybe you say, but Alex, I know driving on the street got risk, but I got well trained. I got a coach instructor to teach me how to drive a car, right? So I got my driving license. So I know how to actually read the road sign, know the rules and regulations. So that's why I'm able to actually drive safely. Now, you able to drive safely, does it mean that driving in the street, there's no risk at all? No, there's still risk. But because you're able to control the car right now, you have the proper knowledge, you are well trained. So that's why you're able to reduce your risk. Now, what does it mean here? Same goes to stock investment. If you invest in a stock without knowing what you are doing, then your risk is very high. However, if you are well trained, you know the strategy, you know what to do, and you go and invest, does it mean that there's no risk at all? No, I'm not saying that. But because you are well trained, you know what to do, what not to do, you're able to minimize the risk. Understand what I'm saying, right? Everything in life, there's risk. Even when we eating, we also got risk on. Why? We risk of getting dirty food, right? Get diarrhea, right? And how we avoid that, right? We make sure every time we eat, we wash our hands, right? Make sure we go to the proper place to eat, right? We order clean food, right? So all these things, does it mean that we won't get diarrhea anymore in your life? You won't. But the chances of you getting diarrhea is lower because you do all the necessary SOP. So right now, you also need to do the necessary SOP for you to actually invest in stock to minimize your risk. Okay, so that's first one. Now, some of you might say, but Alex, when I invest in stock, I don't have any financial background. I don't have any accounting knowledge, investing knowledge, or I don't have any financial knowledge, right? I thought investing need to be a professional. Now, that is a big misunderstanding, right? You do not need to have a financial background. You do not need to have what? ACCA, CPA, CFA, CPA to actually invest. In fact, the student that I have, right, that normally generate great result, surprisingly, from these three different fields, engineer, IT, and housewife. Right? Now, why these three different fields, I don't know. But surprisingly, out of thousands of my students, engineer, IT background, and of course, housewife, able to actually generate good results. So what does it tell us? It tells us that we don't need to have a financial background. Now, does it mean we do not need to know anything at all? No, I'm not saying that, right? But we just need to be financially literate, right? We do not need to know how to prepare the account. We do not need to know how to do up the account, but we just need to actually able to read and understand certain key ratios, key matrices for us to actually make a sound and better decision, right? So what to analyze, So for me personally, which I also coach my students around the world, these 3R strategy, which is a very, very important rule in value investing, so that you're able to actually step by step execute the value investing trade, right? Now, what is first R? Right? What is first R? Again, when we invest, we are investing in the business. The business must make money, right? So we want to actually invest in the right business. We don't any business also invest, right? We want to invest in the right business, got a strong competitive advantage, got a good growth potential, right? Can make good money at the same time, sustainable profit and cash flow, right? Now, next, okay, after looking at the business model, right, we want to look into the next thing, which is the management. Now, why looking at management is extremely important? Because behind every business, there's a group of people running the business, right? Now, doesn't matter how good is a business, if the management, CMI, okay, cannot make it, okay, just in case if you don't know the shortcut, right? The business will deteriorate, right? But if a good business plus a good management, right, they'll make better decision, the business will make more money, make more profit. That is how, as an investor, we make more money. Can you see that? Right? Of course, after we identify good business, good management, with good capabilities, good experience, good integrity to protect the normal shareholders' wealth, then we want to apply the third R. Okay, third R, which is the right valuation versus price. Okay, we need to determine the value, okay, so that we're able to actually buy when it is undervalued. So when we're able to actually buy undervalued, if the company pay dividend, we'll receive dividend, okay, as a passive income. And of course, when the management able to actually perform, okay, make more and more money together with the great business model, and the revenue goes up, profit goes up, cash flow goes up, the value will goes up, and the share price will goes up as well. So this is a step-by-step process for us to identify good business, and of course, where we know when to buy, and of course, know when to sell. Okay. So step one, find a proven track record strategy, right? Step two, after you learn the proven track record strategy, you need to apply it, right? You need to actually take action, and which leads to step three. And I think this is the most important step, right? So that you're able to actually execute it, right? Low risk and able to generate good considered return that you deserve. Step three, which is get yourself a mentor. Now, why this is so important, right? Now, you can learn a lot of things today, okay, on Facebook, on Google, on YouTube. Would you agree with me? But a lot of things out there, they are just theory. Okay? They are just theory, right? You can learn a lot of things from books, right? But how do you actually apply, okay, what you learn from all this theory? By getting yourself a mentor able to actually help you to do that. Now, why do I say that? Let me share with you my experience. Now, I started investing at the age of 19 years old, so about 10, 11 years ago. In fact, let me share with you my trades back then, right? So, this was Maybank, right? This is my broker account. One of my trade, okay, back in like 10 years ago, 2011. So during that time, I invest in Genting Malaysia and Padini. As a Malaysian, I believe you know these two companies, Genting Malaysia and no, this is Genting Berhad. Sorry, Genting Berhad and Padini, right? So during that time, at October 10th of October, I bought it at 9 ringgit and 9 cents, and Padini I bought it at 88 cents. Okay. Now after I buy, just 1 week later, you see 18th of October, just 8 days later. 2011, Genting from 909 shoot up to 996. Padini from 88 cents shoot up to 1.02. Within just 8 days, I make a 20% gain as a total beginner. Would you agree with me that that's a superb result? I think that's a very fantastic result. Would you agree with me? Now, after I make money, I got excited. I decided, you know what? I already make money. I need to sell. Sell. By the way, S stands for sell, right? So I decided to actually take profit and sell, right? So after I sell, immediately the next day, right, on the 19th of October 2011, for some reason, Genting share price shoot up to 10 ringgit and 4 cents, and Padini share price shoot up to 1 ringgit and 4 cents. I'm like, walao, I missed the boat, right? The share price keep on going up. In fact, I read from somewhere, okay, or I think I Google search somewhere. Somewhere actually tell me, teach me, when there's momentum, okay, when the price still going up, okay, I should not, okay, sell it off. I should actually catch on the momentum and ride on the momentum, let it grow, right? Because of that, I decided to actually buy back my shares, buy back my Genting and Padini of course, at a higher price than I sold. So I buy back. So after I buy, something interesting happened, right? Something interesting happened. Padini, 1 month later, decided not to go anywhere. Still stay at 1 ringgit and 4 cents, right? Still at 104. I'm like, seems like Padini have no momentum at all, right? Never mind, okay? Interestingly, right, Genting still have momentum, right? Genting still have momentum. Now, what I did was, I sell off all my Padini because there's no more momentum, right? I decided to sell it and cash it, buy it into Genting, right? Genting, because Genting, you know, good business, right? Casino business, entertainment business, right? And there's still momentum. I decided to actually add in more, right? Now, guess what? After I buy, the share price drop, right? And this is the time where I think, wow, share price will drop, huh? Because I never experienced share price crash, right? Until, wow, I bought at 1080, the share price crashed to about 1030. Now, some of you maybe will say, Alex, right now you panic already, right? The share price dropped from 1080 to about 1030. Now, no, I didn't panic. In fact, I learned somewhere. When everyone is fearful, I must be greedy. When everyone is greedy, I must be fearful, right? Now, when a share price drop means what? Means everyone is fearful, right? And since everyone is fearful, I must be greedy. I must buy even more. So I decided to actually buy even more at 1030. So after I buy, who knows, the share price continue to drop to 930, right? You know, during this period, I just panic, right? I don't know what to do. The share price just crash. How many of you have this same experience? When you buy, the share price drop. When you sell, the share price goes up, right? Very frustrating, am I right? So I understand how you feel because I feel that myself. Now, luckily, I actually decided to actually sell back then. I sell it back then. Now, if today I continue to own Genting share price, this is my result, right? After 10 years, my result crashed 50%. Can you see that how bad it is if I continue to actually own Genting share price? Okay. Now, another strategy that I use is called technical analysis, right? Technical analysis, and using some technical analysis that I actually learned from different books, I founded this company called CSL, right? And I bought in May 25th, right, 2012. Okay, and I bought at 157. Now, after I bought at 157, right, the share price within like 1-2 weeks crashed, you know, right? And recently I realized the company already delisted, right? Luckily, I decided to sell early. How many of you can see that my result just sucks? Right? And because of that, I lose a lot of money, and I realized that I didn't really know how to invest. So because of that, I decided to actually get myself a mentor to actually teach and guide me how to invest. Because why? I realized Warren Buffett, the richest man in the world, also got mentor, right? His mentor is called Benjamin Graham. Since the world best investor in the world also got mentor, who am I, right? I need to actually get myself a mentor. Would you agree with me, right? I mean, the best also got mentor, right? I must have a mentor. So I realized that these two gentlemen actually teach value investing in this school called Columbia Business School. But during that time, I don't have money. I do have about 20-30K ringgit to fly to US to actually study there, right? But I don't have the money. So I did not go to Columbia Business School. But I'm glad that upon chance, I made up this gentleman. His name is called Ken Chi. And he happened to actually go to Columbia Business School and learn the true value investing strategy and come back to Malaysia and Singapore to teach people like us how to apply the proper strategy. So I decided to actually learn from him back in 2012. After I learned and applied, of course, I think I generated the result that I deserve. In fact, let me show you my transformation. Right? In fact, let me show you my passive income. Okay? So this is my passive income. So I generated about 4,007 ringgit. I mean, this month, okay, January 2012, 21, right? February 9,000, March 14,000, April 6,009, May 4,000. Every month have okay? Every month have. June 4,003, July 18,000, August. Okay, August also have already, but I didn't put into it. For the past 6-7 months, my pure passive income, I generated about 62,000. Now, can you see that? This is the important part about getting a proper mentor, learn it, apply it, then you'll generate good results. In fact, this is by Tony Robbins, right? I believe a lot of you know Tony Robbins. The best way to get trained, okay, is to get mentored. Live all by reading, okay, or watching videos by master. That way, you start executing based on the lessons from the best. Okay. Now today I don't have a lot of time to actually go through with you. In fact, my team member behind always tell me, okay, keep asking me to wrap up because I still have 1 more minute to you. Okay. So if you want to actually continue your learning journey with me, right, I'm actually conducting a Behind the Stock Masterclass, a 2-hour session is free, okay, so that I have more time to actually go through with you. I can speak much slower, okay, so that I can actually continue to actually add value to you, right? So if you want, you can scan the QR code right now and register yourself accordingly. So during this 2-hour masterclass, I will actually share with you, okay, I'll ask you, understand you, okay, what is the challenges that you're facing in your investing journey, right? And after understanding your challenges, I will actually do my best to actually help you to remove it, solve it, so that you can actually invest safely, generate good results. I'll share with you another strategy called a MGV investing strategy, and share with you how you can actually invest in US market, okay, and generate good results in US dollar. And you don't need to fly to US, you just do it in Malaysia, right? And of course, I'll share with you the real life case study, how you can utilize MGV strategy so that you're able to actually pick a good stock, buy undervalue, so that you're able to generate the results that you deserve. Okay, I believe I still have another 30 minutes before I go to the Q&A, right? So during these 30 seconds, right? So during these 30 seconds, just scan the QR code right now, okay? Fill out your form, register accordingly. I will see you in the 2 hours masterclass. Of course, after you scan the QR code, you will see the date, right? And of course, the time. Right? Just register accordingly. I will see you there. Okay? Good. Okay. Of course, if you have any question, okay, feel free to ask in the Q&A so that the team will able to actually bring it up for me, and I will be able to actually support you guys for the next 10 minutes.
All right, Alex, the master speaker and trainer of 8VI Malaysia, Sendirian Berhad. I hope you guys learned a lot. I couldn't stop myself. I wanted to go for lunch, by the way, Alex. I wanted okay, let me heat up the food and eat while listening to you. But everything was just so interesting and there was so much to learn, which is why we have so many questions, and I'm sure you can't wait to answer them either. So Sui Feng would like to know, people are driven with greed. So how will you convince people that your strategy when it comes to value investment takes time versus just get rich quick scheme?
Yeah. So of course the market is driven by sentiment, driven by emotions, right? And of course the greed will actually drive up the share price, and fear will actually drive down the share price, right? So this is actually very similar to the next question, right? FOMO, fear of missing out, right? So as an investor, we need to be always in check with emotions. Now, how to be always in check with emotions? That's why it's very crucial for us to know the valuation of the business. So with the valuation, then we know that the current market, whether it's a greed, which we shouldn't buy, or it's actually a fear where we should actually buy. So we should actually take opportunity, right? Doesn't matter whether it's greed time or fear time. When the time is fear, we take opportunity to buy it. But when the market is at greed, we actually take the opportunity to sell it to actually take profit. So we want to actually be aware, right, of our emotion, but not get affected by our emotions when we do a strategy here, our investing strategy here, right? So when we talk about making money, right, I believe a lot of you probably aware that if you go for get rich quick strategy, get rich quick scheme, right, that is the fastest way for you to lose a lot of money. So making money at the end of the day, other than we need the proper skills, knowledge, strategy, I think patience is also very important.
That's a very good point. Now, someone pointed out that price is the fact, whereas value is an opinion. It's very subjective. So what formula do you use to ensure that it is objective?
Agreed. I mean, so there are various valuation strategy, right? So we have price to earnings, price to growth, PEG, price to sales, DCF, DFE, dividend yield, all these things, right? So there is no accurate valuation. Okay, there is no precise valuation. Let's say, for example, let's say I take an LV bag as an example, right? So LV bag probably costs like what, 10,000 ringgit, right? Let's say LV bag, right? Someone willing to pay 10,000 to buy the bag, but another one, they definitely don't. I mean, some other people, they won't want to pay 10,000 to buy the LV bag. Why? Is it because the LV bag is bad? No, it's just these two different persons value the bag differently. So who is right, who is wrong? No one is right, no one is wrong, right? So how do we able to value the bag not accurately, but more appropriately? Because we cannot value the bag accurately, right? We can only evaluate more appropriately so that we can make a better investment decision, right? So how to understand the bag? Okay, the more you understand about the bag, okay, the more you understand the bag is from what material. Okay, you appreciate the handcraft. Okay, you appreciate all the process, okay, when actually designing the bag, right? And of course, you value the quality of the bag. Then you're willing to actually pay higher price to buy the bag. Would you agree with me, right? But if you think that the LV bag is just another plastic bag, right, then you won't want to buy the LV bag. So again, same goes to business, right? The more you understand the business, the better we able to value the stocks, the business appropriately. Of course, using a different valuation strategy.
Now, I think a couple of questions that I saw earlier, they were asking, like, how do you even make time to assess any, all the stock that you're looking at, especially for people with any sort of a work schedule that might be very difficult? No, do you have any advice for people who want to start out, but they're also thinking, no time to look at it every day lah? Then how?
Thank you. I like the Malaysian accent that they have there. So, a lot of people have this misunderstanding, right? Thinking that investing in stock market, we need to monitor the stock chart every single day, every single minute, right? I mean, that's impossible because everyone has a life, right? Have a career, have a job, have loved ones to actually pay attention to, right? Now, we do not need to monitor the stock chart every single day, right? In fact, we just need to review our investment portfolio once every 3 months, which is quarterly, right? Now, what do we review? We don't review the stock price. I mean, the stock chart is just a stock chart, right? We want to review whether the business is still performing. If the business is still performing, the value goes up, and when the value goes up, we will make money. Simple as that, right? But of course, we need to give time to for the business to actually make more money, right? Because we want to make more money, right? So again, time is made in the patience, not in the buying and selling every single day.
I think some of our friends are asking, what are the most important catalysts in any stock market? I guess that's a big question because any is a little bit, but I'm pretty sure you have something to say about that, Alex.
I mean, as you say, Kevin, right? What is the most important catalyst in any stock market, right?
Yeah.
Personally, I focus on 3 things, right? 3 things. First is the business moat. How strong is the company? Are they strong and sustainable? Right? What is the company's competitive advantage? Right? And second is the growth potential of the business. And third is the valuation. I need to actually buy it at undervalue or fair value price. Now, the catalyst definitely won't be any macroeconomic catalyst. Why? Because macroeconomics, I mean, we were not able to predict when is the next crash. We will not predict when the Feds will do any action to boost the market, right? We will not know whether Bank Negara will do what to actually boost the market. But okay, when we actually follow the business, we will understand how the business grow, right? How the business able to actually be sustainable for the next 5 to 10 years.
Okay, a lot of people are asking about glove. What's your opinion on the value of glove companies right now?
Interesting. I mean, just a side topic here. In fact, today is Saturday, right? I mean, tomorrow, if I have a YouTube channel called V Channel, so it's free. If you want, you can go to YouTube and go to V Channel and subscribe and watch my video there, which I'm covering, right? I'm covering about the glove stocks in Malaysia. So because I can see that there's a lot of questions here, so the glove stock, I'll get you guys to actually watch the video so that I have more chance to actually answer more questions. How about that?
Yeah, I think that would be a great thing because I think some of the questions here are not very easy to understand in a very short time. In your opinion, I think one of the questions was, is it wiser to manage your own investment funds, or should they just look into like getting someone to do it for them?
Well, I would say that if you don't know how to do it by yourself, definitely it's much better for someone to do it for you, right? It's just like if you don't know how to drive a car, it's much better for someone to actually drive the car for you. But the question now is this: who is the someone, right? Who is the fund manager that's helping you to manage your fund? Now, please don't compare I mean, ourselves with those, billionaires, right? Those billionaires have those private fund manager that every day, every month report and what is the actions being done. Unfortunately, most of us here, we have no idea who is the fund manager that is managing the fund. Right? It's just like our previous speaker there. Just now shared. The skill of the fund manager is very important. Right? So if you, unfortunately, the investment that you make, you invest in a fund where the fund manager skill is not the best, then your return will be, Now, at the end of the day, I think it's all our hard-earned savings, hard-earned money, right? Who is the one that actually has the highest responsibility, highest trustworthy, highest reliability level to protect our money? I think none other than ourselves. Would you agree with me? Right? If you don't learn to actually protect yourself, no one else will protect for you, because everyone had their own self-interest, including myself, including Kevin, including the audience that is listening here, right? If we don't protect our own money, who will protect our own money? Our money. No one. Right? So we need to actually protect our own money. If we don't learn how to protect our own money, we are just being irresponsible towards our own money. We are just being irresponsible towards our own life, right?
All right. I'm afraid I have to stop you here, Alex, but I would love to say that Alex is still going to be in the main lobby, and you can reach out to his company there as well, 8VI Malaysia, Sendirian Berhad. Alex, thank you so much for joining us here today.
Thank you. For those who want to join my 2 hours masterclass, you can join.
Now let's move on to the next speaker that we have in this breakout room today. Soon Chong has more than 11 years of experience in fund management and investment research. He joined ValueCap Group in 2010 as investment analyst and subsequently promoted as vice president in investment research department, where he covered the Malaysian and ASEAN markets. He was then designated as the senior VP and portfolio manager. In 2015, he managed equity funds ranging from exchange-traded funds, discretionary institutional funds, to ESG funds with over 2 billion ringgit in asset size. Now, prior to joining ValueCap Group, he worked at an investment bank for 6 years, which gave him exposure on a wide range of investment banking knowledge, including treasury, fixed income, equity derivatives, and internal audit. His other experience includes various advisory and audit roles in a Big Four accounting firm. Today, presenting the topic of exploring ETF investment opportunities in Malaysia, please help me welcome the portfolio manager for investment from Kenanga Investors Berhad, Mr. Ong Soon Chong.
Hi.
Mr. Ong?
Hi, Kevin. Thank you very much for the introduction, and a very good afternoon, ladies and gentlemen. Okay, so today I'm going to share with you guys on the topic of exchange traded fund, or in short we call ETF, particularly in how do we invest, and in the what is the opportunity that we have in Malaysia when you invest in ETF. Let's just start with what is an exchange traded fund, or what is an ETF. ETF is not something new in the market, but I believe it is still not very familiar by a lot of retail investors, and even for institutional investors as well. So for those who already have some idea of what ETF is, please bear with me, and I will go through the more basic introduction, and before I go into a more in-depth topic of discussion. So when we talk about ETF, remember there are 3 main keywords that we want to talk about, which is an ETF is an open-ended fund that tracks an index and trades on an exchange like a stock. So the 3 keywords is a fund, which is a pool or a basket of securities. Okay, it can be any type of securities. Okay, and the second keyword is it tracks an index. Okay, and it trades like any stocks on Bursa Malaysia or any other exchange. So let's look at what actually ETF essentially is. So it sounds like, from my explanation just now, it sounds like it is a bit similar like unit trust and also listed shares. So it's actually a hybrid of between these two. Okay, so it has the characteristic of a unit trust fund, whereby it is a portfolio. It is a portfolio or a basket of stocks. Okay, underlying can be equity, it can be bond, it can be commodities. Okay, it charge management fees. Okay, you can create and you can do redemption of the units. Okay, this is like a unit trust, a typical unit trust. On the other hand, it has the characteristic like any other listed shares that on Bursa Malaysia that you can see today. Okay, it trade through a brokerage account. Okay, meaning which if you have any trading account like with Rakuten or Kenanga or Maybank, you can buy and sell it through the exchange, and the settlement is the same as any other buying any other shares on the exchange, T+2 of settlement. There are many types of ETF that is available. It just depends on, remember just now I mentioned the characteristic of ETF. It is a basket or a portfolio of securities. So it depends on what is the underlying that determine what type of ETF it is. So very more common one is the equity ETF, and we do have fixed income as well, commodity, money market. We do also have alternative assets ETF like Bitcoin ETF, real estate ETF, but all these are not available in Malaysia currently, but in overseas is quite common. And last but not least, we have this derivatives base, which is like inverse and leverage type of ETF. Let's go into more detail of looking at what ETF, the difference between an ETF and a unit trust fund. More often than not, I will always get question from the investors that just now you mentioned the characteristic and all that you mentioned sounded to me very much like this is an ETF. An ETF is just like a unit trust fund. What is the difference actually? So let's have a look into this, because I also like to use unit trust fund as an example to explain what ETF is, because most of the Malaysian investors are more familiar with unit trust fund. So let's look at it. Okay, so for a unit trust fund, we buy and sell through a unit trust agent. While ETF, like what I mentioned, you buy through any broker, broking account like Rakuten and so on. And when you buy into an unit trust fund, the price is unknown. Why? Because when you subscribe to a unit trust fund, or when you buy, they will use the end of day forward pricing. So end of the day, only you will know how much you actually the amount that you have bought. While ETF is just like when you're buying any shares on the exchange, that when you execute the point, you already know what price you are buying, and the investment amount is deducted upfront for unit trust fund, while for ETF is T+2, just like any other shares that listed on Bursa. Also, what more very important point here is that for a unit trust fund, you need to pay a sales charge of up to 6%, depending on which fund that you are talking about. But on ETF, it's actually very low cost because it doesn't involve any of the sales charge. What you need to pay is just the normal brokerage. For currently, we know that the market brokerage fee has been getting lower and lower. We have many brokers that actually offer extremely low brokerage fee. And another differentiation is that the management fee that involved for a unit trust fund, management fee is typically 1% to 1.8%. While on ETF, again, what I want to say is very low cost. The management fee typically below 1%. In the market, generally, they charge like 0.6 0.4 to 0.6%. Okay, so it is very much lower when come to the fee that in long run will give you a better return. And what the last one is the dividend. For a unit trust dividend, it will be automatically reinvest into a new unit for you, while for ETF, it will be just like any stocks, it will pay you in cash. Some of the benefits of investing in ETF is that low cost, like what I mentioned, management fee, no sales charge, and so on, and diversity. Diversity, it is actually, what I mean here is that it's a pool of stocks that you can have a diversification inside, and there are many available ETF here in the market that can give you exposure into different geographical market like China, US, ASEAN, and so on. So it will provide you with a diversification, and it is very transparent when you invest in an ETF. This is because for any ETF, every day they will announce, or they will publish all the component stocks or securities that in a particular ETF. Compared to a unit trust fund, when you buy into a unit trust fund, basically you won't know, what the fund manager is buying or selling, right? What you can see is the NAV price every day. You have no clue on, what are the stocks that they are holding, how good they are, whether they have something that you are not comfortable with inside and all that, you won't know. Every month, they publish a fact sheet that tell you top 10 holding or top 5 holdings, So when it comes to transparency, ETF can provide you a much better one. And it is very easy, to invest into ETF. You just need to open an account, and you just a booking account, and you just trade, So and you can buy and sell anytime, as long as the exchange market is open. So it is very easy to go in and out of an ETF. So like all other or any financial instrument, ETF do have a Sharia or Islamic version of it. Okay, so what is a Sharia compliant ETF, or IETF we call? IETF is basically is just the same as the conventional ETF, but what they track. Remember, just now I mentioned when we talk about ETF, there are 3 keywords. One of it is the index tracking index, right? So the index that we track here for an Islamic ETF, it must be a Sharia compliant index. So to be a Sharia compliant index, it simply means that all the underlying securities or any stocks that inside the ETF funds, it is actually Sharia compliant securities, and it is governed under the Sharia governance, meaning which that at any point in time, not only at the beginning point when we put the stocks into the ETF funds, from time to time, at any point in time, you can be rest assured that the Sharia compliant board is governed on this one and make sure that your investment is Sharia compliant at all time. Okay, so basically this is all that I want to share on the basic of what an ETF is. Let's now go into look at how investing in ETF in Malaysia. In Malaysia, currently, we have 20 ETF listed on Bursa Malaysia, 14 conventional ETF, 5 Sharia compliant ETF. Sorry for the typo. I think it currently is a 6. It's a 6. Okay, so we have 1 fixed income ETF, 1 commodity, and 6 leverage and inverse ETF, and the rest are all equity-based ETF. And for Sharia compliant ETF, equity ETF that we currently have is 5 here. Okay, so this is the landscape of the ETF in the Malaysia. And today I would like to introduce to ladies and gentlemen here today. I would like to introduce you my ETF series of these 4 ETFs, which is a Sharia compliant ETF as well. So I will go into each of them one by one later. This my ETF series is the ETF that currently issued and managed by Kenanga Group. The first one, my ETF Dow Jones Islamic Market Malaysia Titan 25, a very, very long name, I know. Yeah, in short, we call it DGIM 25. Okay, so this ETF basically invests in the 25 largest Sharia compliant stocks in Malaysia. Okay, so in other words, when you buy into the unit of the ETF of this DGIM 25, what you actually invested in is that 25 largest Sharia compliant stock. So for the 25 largest Sharia compliant stock in Malaysia, you can see the holding. You can see the holding. You can see the holding here. We have all the big and good names in that listed in Malaysia. Top Glove, Petronas Chemical, IHH, and so on. And in terms of sector allocation, we can see on the right here. Okay, sector allocation wise, it is actually very widely well diversified. You can have, from telecommunication to industrial to healthcare to consumer product, plantation, and all that. By one single product that you invest into this fund, you can have a good, well diversified portfolio. And this ETF actually is meant to be a very stable, stable, well diversified for long-term investment, because when you own all these large companies, large and good companies, it can provide you a good return in long run. And what actually the beauty of investing in ETF? Let me explain more here. Okay, for an example, just now when we go through the earlier speaker's presentation, one of the question asked is that, how much time do I need to spend actually as a retail investor, to analyze stocks, to buy stocks? I don't have the time because I'm full-time, working, and I'm just a part-time investor, So by buying into ETF actually can help you to solve some of the problem. Why? Because an ETF basically they track the large, like for example, this ETF, they track the large stocks. Okay, so whenever a sector, particularly like glove, do very well, the market cap will automatically grow, right? The share price go up and the market cap of that particular stocks will grow. So the weighting in this ETF fund will grow. So like for example, you look at our current holding, the fourth largest is precious metal and aluminum. Okay, so as an investor, I may not have a time to go and monitor, from banking sector to plantation CPO price to aluminum price. Oh God, who am I to, how much time do I have to need to go through, or monitor so many sectors and all that. So if I buy into this product, when aluminum prices do well, this P metal price, this particular stock's price, it will automatically go up. It will be go up, and when the market cap gone up, it will carry more weight in my ETF, and my ETF fund will buy more of this stock for me. So automatically, the ETF will help you to do rebalancing, okay, from time to time to pick the good stocks to put into the ETF. So save you all the hassle of need to go through all the sectors, and you won't miss out any good run. Like for example, last year our ETF do well because of we have a lot of component in the glove stocks. The second ETF that I would like to introduce to you guys is this My ETF MSCI Malaysia Islamic Dividend. As the name suggests, it is a ETF that focuses on dividend. Okay, so when you buy into this ETF, what do you actually invested in? Is that you are buying into a large to a small cap of companies that persistently pay above average dividend yield to a company. Okay, so the keyword here is persistent and above average dividend yield, meaning which that in this ETF we don't focus only to pick the highest dividend paying company. No, if there is only one of that the company pay good dividend, no, we don't pick that. The ETF itself will actually pick based on the 3-5 years of a track record of all the companies, okay, listed in Malaysia, to pick companies that persistently pay above average dividend. So in long run, you will enjoy a consistent and also stable long-term dividend income from this ETF itself. So as you can see that, we have good dividend yielding company here. Top holding from here, you can see we have SAMW, we have Petronas Gas, we have Maxis as a telco, we have KLK as a plantation company, very well diversified. So it will give you a better mix so that, diversify out your risk as well. This is the third ETF that I want to share. This one is my ETF, Dow Jones US Titan 50 ETF, okay, or in short, we call US 50. So this stock basically invests in 50 largest Sharia compliant stocks listed in the US market. Okay, why I would like to put more focus on this ETF today is because of I want to share with ladies and gentlemen here of that US market has been doing very well for the past 2 years since after the crash of a COVID crisis, the market in the US market has actually came back very strongly, driven mainly by the tech company. When everybody work from home, you can imagine that all the tech related companies has actually doing very well, and the market has gone actually very well. So when you invest into this US 50 ETF, which is listed on Bursa, you actually have exposure in the US stocks. This actually save you the hassle of that you need to go and open a foreign trading account, you need to convert your cash into USD, and to go to study what is good company listed in US and buy and own. This is so too much of a hassle. So only when you just buy into one particular what do you call ETF here, you can actually have all the benefit of the whole thing of the buying into own the 50 largest US 50 stocks. You can see that from the top holding. Okay, the name Apple, Microsoft, Facebook, Alphabet, which is Google, Tesla, Johnson & Johnson, Visa, and all that are a household name, right? This is, I believe, all this product that you all have been using day to day, and these are the good, very good company. By just investing into one single product of my ETF US 50, you can be a owner of all these companies, and when all these companies make money, you can make money from them from there as well. Okay, this is the beauty of an ETF. Let's look at the last but not least, the fourth ETF that I would like to share today. Okay, this is the my ETF MSCI C Islamic Malaysia C Islamic ASEAN ETF. Okay, so this is basically help you to localize access to the Southeast Asia market. When you buy into this ETF, what do you actually buy into is that, what you buy into is that the stocks of the five ASEAN countries, which is Malaysia, Singapore, Philippines, Indonesia, and Thailand. Okay, so by just one single ETF product that you buy into, you actually have exposure to the high dividend yield company into these five countries. Okay, as you all know that ASEAN markets has actually been badly hit by the COVID situation. Okay, and as we can know that now the vaccine rollout has been aggressive, and the reopening the economy or reopening of the economy is on the way, and I believe that ASEAN stand a very good chance for the next 3 to 5 years for the recovery to get the economy better, and this is a very good proxy for you guys to actually go into investing into ASEAN market. And for the top holdings, we can see here that, you know, we have Telekomunikasi Indonesia, which is a telecom equivalent of Malaysia. Okay, we have Bangkok Dusit Medical, which is the biggest hospital group in Thailand. Okay, PTT PLC. The third one, PTT PLC, we can see here is kind of like a Petronas equivalent in Malaysia. Unilever, you know, I'm sure Nestle Malaysia is something that everybody familiar with. So this portfolio is actually very well diversified and give you all the good names across the ASEAN countries. So after I introduce you these four My ETF series, you know what, again, I want to mention here is how to invest in ETF in Malaysia. Is as what I have mentioned just now, is very easy. What you need to do is just to open a CDS account or a trading account with any of the broker, and when you have money, you know, you can start trading. That's it, as easy as that. You know, it won't take you long. Now come to the last part of my presentation. Okay, after I tell you what ETF is, and the second one, you know, after I tell you what I recommend you the 4 ETFs. Okay, now let us look into how do I use ETF in my investment portfolio. And first of all, let's just answer the question of, you know, how can ETF actually value add to my portfolio? Okay, first of all, in the beauty is that, you know, the diversification. Okay, like what I mentioned, ETF is a basket of stocks. You know, one single instrument that you buy, it cover you many, you know, geographical exposure, and it can go to like many other stocks as well across sectors and so on, and it manage your volatility when compared to you buy a single stocks and a basket of stocks. Okay, obviously a basket of stocks has a lower volatility. You know, when you buy one single stocks, the stock can just drop 10, 15, 5%, you know, a day. But when you buy into a basket of a portfolio stocks, the volatility will be much lower, and it can help you to generate regular income or higher yield here. So it is a better choice for people who like to be in the long-term return, okay, to hold it for long-term. And you provide flexibility. What flexibility am I talking about is that, like for example, US 50, the My ETF US 50, you know, it gives you a flexibility of jump into US market, you know, immediately. You know, I don't need to open any other accounts or whatever, you know, as long as I have a Bursa trading account, you know, I can just buy into US, you know, today and sell tomorrow, and also then jump into ASEAN the next day, you know, and exit next week, you know. So it gives me the kind of a flexibility and also trading opportunity. Okay, this is the beauty or benefit of having this, what do you call, having this ETF into your portfolio. It is a bit difficult to imagine when I mention, you know, diversification, you know, volatility, you know, and so on. Let's look at the illustration of this investment, okay, portfolio with the ETF inside. Okay. So what we have here today is that two portfolio as a comparison. Okay, the first portfolio we have, we call it portfolio A. Okay, for portfolio A, we have say 30% cash and 70% which are used to buy 3 to 4 local stocks. Okay, in portfolio B, I put ETF into my portfolio. Okay, so just look at the cash part. You know, from a 30% cash, I can leave 20% cash and I buy fixed income or dividend ETF of 10%. And while by doing this one, what I can have is chances are I will have a higher yield, okay, return, and also better regular income. Okay, depends on which dividend ETF that you buy and fixed income dividend that you invest in. So the the second one that we can see from the equity exposure here, you know, in terms of instead of 3 to 4 local stocks, you know, I have one that, you know, I can have a broad market like just now, DGIM 25, you know, I have the whole market as a base, and I buy on top of the whole broad market exposure. I buy into 2 or 3 conviction stocks that I like. Okay, so this will definitely, you know, I won't miss out anything, you know, just in case if my 2 to 3 conviction stocks, I got it wrong, you know, at least I have the whole broad market here. And also I can have another 20% that I can jump into overseas exposure, like my US 50 or the ASEAN ETF. Okay, so by having this, you can see that you can compare these 2 portfolios. Definitely, I will have more diversification and I will have a lower volatility, because these 3 to 4 stocks, if go down, means it will be significantly impact my portfolio. While this one with a lot other, you know, stocks component inside, I have a lower volatility, and also regular income, higher yield here, and also give me a more flexibility of switching in and out from this into geographical market or any other combination that I would like to have by adding into this ETF. Okay, so this is how I try to illustrate the portfolio of with an ETF inside. My sharing today is up to here. So let's go into the Q&A session from here. So back to you, Kevin.
Thank you so much, Soon Chong. Can we see me? Yes. Hi. Thank you so much, Soon Chong. Definitely ETF is something that I think I would be very interested to learn more about. And now we have a lot of questions. So before we do that, I have to tell all of you, by the way, that the lucky draw questionnaire has to be filled up before 4:30 p.m. So make sure you do that in order to qualify for the final lucky draw happening at the end of today's program, where you can win thousands and thousands of ringgit worth of prizes. So let's take a look at the Q&A submitted by our participants. Now, Wee Sui Fong asked, because there are limited ETFs listed in Bursa, are they sufficient liquidity?
Yes. Okay. So liquidity is always the first question that people ask me when it comes to ETF. Honestly speaking, liquidity is an issue when it comes to an ETF. Okay, but Bursa Malaysia has actually partner with all the ETF issuer in Malaysia to provide more liquidity. And in fact, just for the information of the audience, you know, Bursa Malaysia actually it is a regulation that, you know, all the issuer of ETF need to appoint a market maker or what we call a liquidity provider for each of the ETF that issued in Malaysia. So meaning which their responsibility is to make sure that whenever people want to buy or sell an ETF, you know, there are always someone that provide liquidity there. So, but sometimes because ETF is not a very well-known asset class in Malaysia, so most of the time you can see that the liquidity is pretty low. But when someone that really interested to buy, when they queue it there, the liquidity provider will have the obligation to actually meet the price. Well, if the price is close to the NAV price of the ETF.
Mm-hmm. Now, another person asked if there are any specific requirements for an investor to invest in leverage and inverse ETF.
Yes, currently there is a requirement that only we call a sophisticated or investor that can buy, meaning which that person needs to fill up an additional form. Actually, you know, just to declare that they understand the risk and so on. Okay, when they open an account with any broker, so that only they can buy and sell an ETF, leverage and reverse and inverse and leverage ETF in Malaysia. But I was told that, you know, Bursa Malaysia is going to do away this limitation very soon. It will be, you know, in the next few months. You know, I believe that, you know, this limitation will be removed.
Mm-hmm. Also, what about, you mentioned that there is Malaysian ETF and there's also global ETF. Is there a big difference in pros and cons between these two?
Yes. Okay. So there are Malaysia ETF and regional ETF or global ETF or US ETF that are listed in Bursa Malaysia. As long as it is listed in Bursa Malaysia, we can buy or sell, as you like. While for the US 50 ETF that I introduced you just now, it is actually denominated in USD. So meaning which when you buy and sell, your broker will automatically actually convert your ringgit into USD for settlement, and without you actually need to do anything or knowing it. Okay, so the asset that you own is actually in USD. So this actually form another part of a diversification for you in terms of the foreign currency.
All right then. One of the things that I personally would also like to know, and it's one of our latest questions, they asked if for investors, is it, you mentioned unit trust and also ETF, is it, would you recommend them to just pick ETF over unit trust fund, or is it just fundamentally different?
Okay, so just now I have been sharing a lot on the differentiation between the unit trust fund and ETF. If you ask me which is better, actually there's no direct answer to this one. It depends on what you need. Okay, unit trust fund, basically what you do is that you pay more fee, okay, for the fund manager, to manage the fund, and you pay the sales charge so that the unit trust fund agent will actually service you, supposedly, okay, to give you advice or whatnot, okay. While the ETF is actually like listed in Bursa, okay, it's also a pool of fund, okay. So it is actually depends on what you need. If you feel that you need someone to come and tell you, come and service you, then you may consider ETF. Or if not, if you are someone who already have an account, buy and sell stocks, why not you just buy ETF? And for me, the best is, again, diversification. You can have some of your portfolio into ETF and some in the unit trust fund. It doesn't actually contradict each other.
One of the very highly voted questions is about, do you plan to launch new Sharia compliant ETF that focus on local mid small cap shares or US market with RM denominated in the near future?
Okay, so this question have two parts. One is a local small cap ETF. Definitely, we are actually exploring into various new ETFs that we are actually have a few in our pipeline. So we are working on it. Whereas on the ringgit denominated ETF, US ETF, we are also actually considering to have another ringgit class for our existing US 50 ETF. Yes, but actually just to share with the investors that just like what I have mentioned just now, when you buy into a USD denominated ETF, it actually makes no difference actually, because you don't need to put extra effort into converting your ringgit into USD and all that. So it is actually as easy as simple as buying any other stocks in ringgit Malaysia.
All right. Joe is asking that how would you compare ETFs by Kenanga with robo-advisors, which might offer lower charges and attractive returns? What do you think the competitive advantage is? Okay.
So Kenanga's ETF is a pure ETF, okay, that listed on Bursa. Whereas for StashAway, when you get into StashAway or Wahid, this type of robo advisory, what basically they do is they will take your money and they will buy into ETF that listed either in US or in Malaysia as well. For your information, one of the robo advisor actually they do invest in our ETF as well. So when you buy into their portfolio, or you invest into their robo advisory portfolio, they actually buy our ETF as well. But they charge extra fee on top of that. So if you know how to do it yourself, might as well you just buy it from the market. But what I mentioned again, always diversify. If you don't know how to do it or you're not sure, the best way is you do both.
There's also a bunch of questions about ETF component stock and also the bidding price. I'm looking at suppose NAV of ETF is 1 ringgit, but the bid price is only 95 cents due to low liquidity. How do we correct this if it doesn't reflect the real value of ETF?
Aha. Okay. If the NAV price is $1 and the bid price is 95 cents, so or the trading price is 95 cents. Okay, so if you are able to buy that simply means that you are buying something at a lower than the actual value. Okay, and in long run the gap will close because of there is an arbitrage in between. Okay, so for example, if I am big enough, okay, if I have a size, okay, I will buy all the 95 cents and I will go to the issuer and I do redemption and I will get back $1. This is how actually ETF and ETF works. So in long run, actually ETF NAV price and the trading price should be very close to each other. So when you see a slight premium or slight discount, it will be normal. But if it's a huge discount, it is an opportunity actually.
Thank you so much. That was the portfolio manager for investment from Kenanga Investors Berhad, Mr. Ong Soon Chong. Soon Chong, thank you for joining us and answering the questions.
Okay, thank you so much for Phillip Capital for inviting me. Thank you so much.
Well, ladies and gentlemen, it is now time for us to, it's actually almost time for us to take another break. So let me see what we have in store. Oh, some very important announcements. Lucky draw, you guys, at the lobby page, there is something happening. You will find a lucky draw questionnaire. Please fill in the form as quickly as possible until 4:30. That's the last moment where you can fill up the form. Here's the clue. You might want to visit the booths to learn more about our partners and sponsors before you try to answer the questions. But answering the questions correctly is very important because you got to complete the questionnaire in order to participate in the lucky draw. How do you win? Well, getting all the answers right will put you in the running for some attractive prizes at the end of the conference. And that includes a Dyson Air Purifier, 2,000 ringgit with a Phillip Master Equity Growth Fund, and more. Do note that the submission will end at 4:30 p.m. Now, one more time. The Securities Commission has endorsed accreditation points for this conference, CPE, CPD, and CE. So if you want these points, please find the assessment form in the lobby, fill it up, and submit it. To ensure the points eligibility, you must only log out at 6 p.m. today. So you got to stick around until 6 p.m. Stay logged in at this virtual conference. When we return, before we move on to the forum session at 4:30, come back at 4:20 because we have another round of lucky draw and the prizes are worth hundreds of ringgit. Utilize this time to visit the sponsors booth because you will need to submit these lucky draw answers by 4:30 p.m. to be eligible for the lucky draw session at 5:45 p.m. Again, we're going to come back at 4:20 p.m. If you get back on time, we will be giving away some prizes and it's going to be worth quite a number of ringgit. So I hope you guys are all excited. I certainly am. In the meantime, I will give everybody a 15-minute break. Be back before 4:20 for a lucky draw. All right, I'll see you soon. My name is Kevin. This is the Phillip Investment Conference 2021.
Hi, I'm Ting from Affin Hwang Asset Management. I hope you guys are keeping safe in this period of time. I think the last 20 years has been indeed a good journey for Affin Hwang Asset Management. I think our success has really been a mark of confidence from investors. One of the principles we held on to strongly over 20 years have been this company must be built on trust and our client interests must come above everyone else in this business. And we truly live it with that spirit. It has been not easy to navigate the market, especially if you look at the last 3 months. What we said we would do in terms of trying to avoid the pitfalls of the markets with the sharp downturn of the market, walk away when the markets are real bad. We will do those things. The other success that we had in the last 20 years as we built the business have been our people. This is something very unique in Affin Hwang Asset Management, where most of our key staff that built this business with me stayed throughout this period of time. I have key management who has been with me for a long time. I've been here for a long time. I started it 20 years ago and I continue to stay in the business. The last thing why we had this journey of 20 million to 60 billion that is sustainable is because we are very passionate about the business. I am passionate about the business. To build this business, we must continue to expand our knowledge in the marketplace. When we first started, we were only managing Malaysian local equity fixed income exposures. The solutions that we provide were all local. But in 2008, when I saw the global financial crisis came as an opportunity for us to expand into Asia, we took a lot of efforts to start to build the team expertise to learn about Asian markets, whether it's in fixed income or equity. So we started that process. And today I'm proud to tell you, one of the reasons why we grew is because we had more strategies beyond just Malaysian equity, Malaysian fixed income. Today we had Asia fixed income, Asian equity. Even a few years ago, about 5-6 years ago, we started the strategy to manage global fixed income. And today we are one of the few local houses that have that capabilities developed within Malaysia. It's my passion really about building people in Malaysia. We will continue to bring on more and more of these strategies that we can build to Malaysia, so that Malaysians who choose to stay in Malaysia can then use this as a platform for them to expand their knowledge and their capabilities. I think the key to develop this business is about having trust with each other. It's very important. David has been with me for the longest time, 19 years. We always said he's my long-lost brother. Today, when I look at the investment team and I look at my core management team, I think the word is that we trust each other. It's not just about getting the people working together, but getting people to trust each other. We can't grow this business with just one superstar. We need to have a gathering of stars. We need everyone to be good in what they're doing and put them all together and blend them in and say that let's work together. I think the key guiding principle that I would have from all my investors is this. We do not manage this money like other people's money. We put our own money to all the funds that you have also invested with you. The total collective staff investments into our funds today is about 120 million. So we have all put our savings there, just like you have entrusted us with your savings. So we don't manage this money like other people's money. We manage it just like our own money. Number two, we understand that one of the key ingredients of success to investments is about capital preservation. There's no point talking about markets when we have lost the capital. It's key to preserve capital, and especially in times like this, when it's very uncertain. It's okay to miss on the upside, but at least on the downside, make sure the capital are preserved. And my sense is that the market probably will have seen the bottom because they are looking past 2020 in terms of economic cycle. They're saying by 2021, all the economies will open up, the markets will start to be more functional. Meanwhile, between now to 2021, what the markets are doing is basically trading on lots of liquidity created by the central banks. And I have the confidence that if anything go wrong in the by third quarter, the central banks or the governments will start to pump prime again to provide the environment for it to flourish. My sense is that while we want to be greedy, want to make a little bit more money in the marketplace, we're also very careful because we know there is